Assalamu alaikum. Abbas Sahab, how are you? Can you hear me now?
Yes, my voice is clear. Walaikum assalam.
Yeah. I was saying salam to you, but your audio was connecting. Now it's very clear.
Thank you.
Mr. Ghulam, good morning. How are you?
Walaikum assalam. Thank you. Fine. Alhamdulillah.
Alhamdulillah. Alhamdulillah.
Sister Zahra, I can see Brother Adnan Ahmed Yusuf here.
Yes, we said we will promote him to panelist right now.
Just see all other senior people also.
Yes.
Sister Amal Al-Masri also, and other some senior people that you can see. You can promote them to panelist.
Inshallah.
Brother Islam also, who was the consultant. Sister Zahra, I think we should start, although the number of participants as compared to registrations is less, but I think we should start. It's a long discussion.
Inshallah, brother. Bismillah ar-Rahman ar-Rahim. والصلاة والسلام على نبينا محمد وعلى آله وصحبه. السلام عليكم ورحمة الله وبركاته. It is indeed a great pleasure to welcome you to AAOIFI's public hearing on the exposure draft of its governance standard, governance and management of investments accounts. We are holding this public hearing in collaboration with the State Bank of Pakistan. Let me take you briefly through the agenda of the session. The first 10 minutes are allocated for the welcoming remarks. Then Mr. Omar Mustafa Ansari, the Secretary General of AAOIFI, will start the discussion on the exposure draft. We will have a prayer break at 12 p.m. Then we will resume or continue the discussion and conclude at 1 p.m. So it's a 3-hour session, and inshallah, it's going to be productive time for all of us. Now, for the first welcoming remarks, I would like to invite Mr. Ghulum Mohammed Abbasi, who is the Director in the Islamic Finance Policy Department at the State Bank of Pakistan, to deliver his welcoming remarks. Mr. Ghulum, the floor is yours.
Thank you. Thank you, Sister Zaira. Bismillahir Rahmanir Rahim. Brother Umar Mustafa Ansari, Secretary General here, Brother Adnan, Brother Islam, and all the colleagues across the globe. First of all, I would like to thank the AAOIFI for giving me this opportunity to say a few words as a welcome remarks on this very important standard, on the governance standard, or on the investment accounts. I think AAOIFI has played a very pivotal role in coming up with the revisions and updation of the standards and also the new standards, whether they are on the Sharia, whether they are on the accounting or auditing or the governance standards. And they are working equally on all segments, all the different components of the international standards, which provide an opportunity to the ever-increasing global Islamic finance landscape, actually to standardize the things, whether they are on the Sharia side or on the regulatory side, or the governance and auditing side. So this is one of the important discussion which is to be participated by all the participants here on the investment account, because I, during my stay and during my working with the Islamic finance industry, have observed that in many of the jurisdictions, investment account regime is not there, that the legal frameworks are not there. And in some jurisdictions, if the legal frameworks are there, then the comprehensive regulatory framework is missing also. So in case of Pakistan, of course, our legal amendments are in process, are under finalization to provide the space for the restricted and unrestricted investment account regimes. So under that, we are working on the regulatory front as well. So I think it would be a right time for not only for the State Bank of Pakistan and other jurisdictions as well, which are working on the investment account regime, actually to take benefit of that standard exposure draft, and whatever the problem they are currently facing, if any, they can share here and discuss in this webinar. And as far as State Bank's is shared vision with the AAOIFI is that to promote Islamic finance, that is by adopting the international standards, like on the Sharia side, we have almost adopted around 32 AAOIFI Sharia standard, while we have many of our regulatory framework, actually circulars and regulations actually cover our auditing standards or the governance standards. But now we are on a focused approach, because State Bank of Pakistan is under transformation journey, where we are actually transforming the whole banking industry within the 4 years time. So we have got the dedicated committees and working groups which are actually reviewing each and every standard for the adoption, whether it's their accounting standards or the Sharia standard, the governance and ethics standards. So again, I think AAOIFI has played a very important role, critical one, especially Brother Umar Mustafa have played a very critical role in coming up with the updation of the standards in all the segments, and whether Sharia or auditing or the accounting or the governance. And today's session is very important, and I will suggest to all the participants that they should actively participate in this webinar, and whatever the issues they are facing, or whether they are, irrespective whether they are in process of making some legal amendment in the laws, or they are preparing their regulatory frameworks. So this would be quite beneficial. Thank you, Sister Zara. Thank you.
Thank you, Mr. Baloum. For my welcoming remarks, I will focus on a few points. One is an overview about the standard and its objective, then a little bit of details about the history of its development, and I will conclude to mention about the process or the approach for managing this session. So to start with, this standard provides a framework for managing and governing investments accounts and other similar participatory investment instruments. It complements the existing Sharia and accounting standard, and it has multiple objectives. One of these objectives is to safeguard the interest of the investments accounts holder and enable for better transparency and disclosure, and ultimately, of course, safeguard the reputation of the Islamic finance industry. When it comes to the history of developing this standard, in November 2021, the project was initiated after the approval of AAOIFI Governance and Ethics Board. And then between 2022 and 2023, 6 working group meetings were held to discuss the standard. The working group consists of 12 experts in the Islamic finance industry from 8 different countries. And of course, the exposure draft and the relevant working papers were presented to AAOIFI Governance and Ethics Board, the Sharia Committee for the Review of Accounting and Governance Standard, and the PIMCC, which is the Public Interest Monitoring Consultative Committee. So the exposure draft was issued in December 2023. And when it comes to the public consultation process, we started the process last month. Specifically, on 12th of June, we held a roundtable to discuss the exposure draft. So this is the second public consultation event, but the first public hearing. And we will hold, inshallah, additional 3 public hearings in due course. After we finish the public consultation process, we will compile all the comments and present them to the relevant working group and board. And after the completion of the due process, the standard will be issued as a final standard. Finally, about the approach for managing the session. The purpose of this session is to learn from your experience and get your feedback. And therefore, we welcome all of your questions in the Q&A tab, and we request you please to avoid the chat box or the chat window. If after this session you still have additional comments, please feel free to share with us on governance@aaoifi.com. This is it from my side. Now I would like to invite Mr. Umar Mustafa Ansari, the Secretary General of AAOIFI, to start the discussion on the exposure draft. Brother Umar.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Thank you very much, Sister Zahra, and thank you very much, dear brother GM Abbasi, for your kind words, for AAOIFI, for myself, and thanks for the SPP for the continued support to AAOIFI in all aspects. And very, very good morning and good afternoon, depending on the places of the world from where you are joining. And Assalamu alaikum wa rahmatullahi wa barakatuh, everybody. This standard is you know, a lot of time we say that this standard is sort of very crucial for Islamic finance and all that, and we say this thing about multiple standards. But there is one thing about this important with this standard which is very significant to understand, is that it handles the maximum size of the balance sheet of an Islamic financial institution, which is quite ignored as of now. A typical Islamic financial institution normally have around 60 to 70%, and at times even more than that. But in most situations, no less than 50% of investment accounts. In different countries, they may be called differently. IFSB refer to them as PSIA, profit sharing investment accounts. AAOIFI refers them as investment accounts and divided into multiple types. There are countries that refer to them as profit sharing deposit accounts or profit and loss deposit accounts. In a nutshell, the unique business model of Islamic financial institutions, particularly we are talking about Islamic banking sector, but there can be certain other type of Islamic institutions that also have investment accounts in one or another form. These investment accounts are covering at least on an average more than 60% of the balance sheet. Why I'm saying that these are ignored as compared to other areas, you will see that on the accounting side, we had recently completed a similar project on these areas, updating all our investment account standards. And during that discussion, we had multiple discussions at the working groups and others. And we asked how many banks actually have a department handling investment accounts. The reality is that while on the asset side and on the services side, we might have proper departments working on that. But for investment accounts, obviously the front end is there. The branches are there and the front end is there and the marketing side as well. But handling of the investment account related issues related to accounting, related to governance, related to Sharia compliance, in most of the institutions, you will never find a department or a function actually in charge for this. This is just one example of what I'm mentioning. And if you guys have different experiences on this part, please make us more knowledgeable about it. But based on our discussions and our own experiences that we have, we can tell you that this is quite a reality, that a lot of Islamic financial institutions don't give enough attention, they don't devote enough resources. The senior management doesn't devote enough time for handling the investment accounts, and these investment accounts are not only crucial for the business, but the relationship with these investment accounts is of a participatory nature, which means that by default, there is a trust and fairness element and ethical treatment element that must be inbuilt in the system, the way we work with these investment accounts. So without further discussion on this significance part, I would just like to mention what this standard is trying to do. First thing, this standard is trying to bring harmonized, standardized, and benchmark practices with regard to the strategy, management, and governance, as well as the internal controls related to investment accounts. Secondly, it wants to promote the true Islamic finance practices in both ends. One, Sharia side, one, the fiduciary responsibility side. Means that while the way investment accounts are actually handled as of now, they create so much similarity with the conventional interest-bearing accounts. And at times, I can tell you that based on the IT systems that we have reviewed, things work at times quite similar to conventional. And that is one of the reasons that a lot of people don't believe in Islamic finance to be truly Islamic. And a lot of people actually feel that irrespective of profits or losses, the return given to the investment account holders is more or less the same, or exactly the same, or exactly as per promise, which apparently creates a Sharia non-compliance risk as well as reputation risk for the Islamic financial institutions. Not only this, we feel that there are fundamental benefits of Islamic finance business model, which are missed out because we are not using these practices currently in a proper way. In addition, there is another element that needs to be understood, that the Sharia compliance of these investment accounts require a lot of nitty-gritties, which are related to the controls and the practices at the level of the transactions that take place. And these unique transactions, like for example, when a person exits from the pool, or when you want to compensate somebody for losses and all that, so gift or other profit smoothing techniques, or when you have transfers between the investment pools. So I'm just talking about some of these things. Again, most of these are covered in this standard, but what I would just want to mention is that these are the areas which are quite ignored. And one last thing, without any disrespect to any of our senior scholars, the computation part for investment accounts is quite complicated, which means that the Sharia board and at times the Sharia departments are not fully aware of what actually happens on the computational part, which means that the institutional Sharia compliance and the institutional compliance with the contractual obligations to the counterparties and the fair and just treatment between the investment account holders in line with Sharia and in line with practical practices comes at risk. And this cannot be done alone on the governance side. We have recently developed and updated our set of the accounting standards on that part as well. Sharia standard is already in place. So now with the completion of this one, we have a complete ecosystem within AAOIFI standards, inshallah, as soon as this one is finalized. So we have the Mudarba Sharia standard and we have the investment account Sharia standard. And then we have investment accounts quasi-equity, that is on-balance sheet investment accounts financial accounting standard, off-balance sheet investment accounts accounting standard, financial accounting standard, transfer of assets financial accounting standard. These are updated and new ones which were issued by the end of 2023. And control standard, which is already also linked with that how to establish control and what remains on balance sheet and what goes off balance sheet from the accounting perspective, considering the contractual obligations and the nature of the investment accounts. And now coming up with this governance standard on investment accounts. While some of the considerations related to true and fair disclosures and presentation and some of the requirements related to just and fair treatment with the investment account holders and all the participating stakeholders are covered in multiple AAOIFI standards at different places, including the Sharia governance framework, including the responsibilities of the audit committee, responsibilities of the board of directors, those charged with governance, etc., and multiple standards. All these things are covered at different places. But this one brings most of the requirements at one place and then enhances and goes into the detail level. The standard name is not only governance, it is governance and management, which means that we are talking about governance normally talks about the high level governance. But when we are talking about management, we are talking about even the controls that need to be established at different places. So in a nutshell, it's a very crucial standard. It fills in the gap which was there in some of the areas related to investment accounts. It completes ecosystem from AAOIFI side by having Sharia standards, accounting standards, and now having governance standards. So whole practices with regard to the investment account significantly improves, we hope. And obviously, we believe that it needs to promote the upcoming, the future of Islamic finance in a better way as well. So one of the most important and most significant recommendations of the standard is that we should move from low-risk investment accounts to high-risk investment accounts, which means that we should be moving towards the more and more Sharia compliance and more essentially close to the core concept of Islamic finance in form of having the investment accounts which are not just sorry to say, and my apologies for some people who feel bad about it, but sorry to say about mimicking conventional deposits, but rather moving towards the right direction. And I can assure you that the business model of high-risk investment accounts and all these are not like against the interest of the bank or the interest of the institution or interest of the customer. I can assure you that participatory model, when it is applied in its true essence, actually supports growth of Islamic finance and eventually supports growth of the industry. So I think I have taken enough time on the initial introduction and the conceptual part about the standard. I can see now we have around 98 participants. Participation is slightly less, I think, as compared to some other public hearings. But and considering the significance of this one, I thought there will be more attendance. But there will be still 3 more public hearings, 2 more in English and one in Arabic. So effectively, inshallah, we'll be having enough input. We hope so. Uh, with that, I'll share my screen with your permission. Okay, so here before I go to the standard itself and take you through the standard, and just to give you an idea that this is a very long standard, I believe I have around 334 slides. So it means that I'll not be able to, I will not be able to discuss every single slide with all of you. But yes, comments are invited on every single area of the standard. So you are most welcome to provide your comments at today or through email at governance@aoifi.com. You can provide all your comments in due course. Now, do we have any questions at this stage about the general concept of the standard, any other issues which are over-encompassing and overarching the overall standard? Please feel free to ask. I can see something coming up in Q&A tab. Okay, this is from Brother Al-Tijani Ahmad. Salam and Walaikum Assalam. Brother Al-Tijani Ahmad, thank you very much for being with us. Okay, there is a hand raised by Brother Hamdullah Hamidi. Brother Hamdullah Hamidi, can you kindly put your comment in the Q&A tab? As of now, I'm not sure we will be able to allow everybody to speak up. So if you have a comment, can you kindly put it in the Q&A tab, or your hand is raised by mistake? Okay, Brother Mustafa Abu Bakr also has raised his hand. Brother Mustafa, again, a request to you that if you have raised your hand to put a discussion point, kindly put it in the Q&A tab because of very long standard and comparatively shorter time assigned, we might not be able to allow everybody to speak up. Only if the time permits, we'll allow you at a later stage to speak up and open up your mics. But as of now, if you can kindly put your comment in the Q&A tab, please. Okay, so in the Q&A tab, we still don't have any comment. In the chat window, I think. In the chat window, there is an interesting comment from our brother Al-Mukhtar Muhammad. This is, I'm from Niger, a French-speaking country. We would like the translation in French if possible. This is a very interesting webinar. Thank you very much, brother. We are actually planning that in future, like Arabic, in future, at least one public hearing should be held in French as well. But for that, to be honest, we need some more time. Actually, we conducted one public hearing in French a couple of years, 3-4 years back. I recall that one was conducted by our Governance Board Chairman, if I remember correctly. But sister, the Q&A tab is not activated.
It should work, brother. It worked for other. I'm not sure the problem that Mr. Mustafa is having. It doesn't have to be activated. Anyone can.
Yeah, that's what I'm thinking.
Yeah. Maybe if he can rejoin or.
Okay, you just allow Brother Mustafa Abu Bakr is, always supporting you if attending all the events. So just try to allow Brother Mustafa Abu Bakr to speak up, okay, if possible.
Inshallah. So I allowed you to talk.
Okay.
Yeah.
Brother Mustafa Abu Bakr, you want to speak? You are allowed to speak now.
still didn't accept.
Assalamu alaikum.
Yeah.
Wa alaikum assalam. Wa alaikum assalam. Thank you very much, brother, for being with us. Please go ahead.
My major worry is I don't know how the Islamic banks officials really take these standards seriously and participate in these exercises. How could AAOIFI make it in such a way that the real players or implementers of the standards key in actively at the development stage and then the implementation stage?
So, Brother Mustafa, what is your exact suggestion in that part then?
I suggest that the AAOIFI Secretariat should engage all the chief executives of the financial institutions in a kind of gathering. It might be remotely, exclusively for them to highlight the importance of these exercises so that they can key in. Let there be specific sessions with them globally or at regional levels to solicit their buy-in so that they will take the development and implementation issues seriously.
Thank you very much, Brother Mustafa. We fully understand that the tone at the top is very important. Unless the board and the chief executives, etc., are not involved into these, understand these standards and not involved in their implementation, it will not work. All our standards normally put responsibility on board, those charged with governance, and the chief executive and the C-suite executives. On the other hand, AAOIFI has initiated a directors and senior management sensitization program, which is an update program for all the most senior scholars, most senior executives within the institution. We do it on a institution to institution basis, and we do it on a general basis. Just last week, we did one such event for the C-suite executives and top management in UAE, about update on the standards and strategy for Islamic finance institutions to be developed in line with the requirements and business model of Islamic finance. Thank you very much, Brother Mustafa. We fully agree with you, and nothing can happen unless tone at the top does not change. But we are trying to do our part on both ends. One, we try to develop the standards, and secondly, we are trying to update the senior executives from the industry. So from both ends, we are trying to do it. I need to be excused for a second, please. My apologies. So thank you very much, Brother Mustafa. We fully agree with you, and we are trying to do our part, and we would like to request our regulators and other partners working, they should also be doing it. Particularly, I would like to request Bahrain Banking Association, who is already present here. We would request Central Bank of Pakistan. We need to work together to update and engage the directors, chief executives, and other C-suite executives to understand better these standards. Without their full support, it will never be possible. I can see 3 hands raised now, and I can see a couple of questions in the Q&A tab. So first, let me take the Q&A tab questions. So first is from Brother Sarfaraz Miakhil. Can we have the draft standard as we had before? Yes, standard is already there on the website. You can just have a look at the standard. Our colleagues have provided the link to the standard in the chat window already. So you can just have a link to the, you click on the link and you will find the standard, inshallah. Thank you very much for being with us. We have our brother Sheikh Hisham Musalkhi, Assalamu alaikum. Did governance standard in general and this one is specific have the obligations like international standards to be applicable, or just it will be restricted to AAOIFIs? Brother Sheikh Hisham, thank you again for being with us. This is Obviously, the countries that adopt AOFI governance standards, obviously for them it will become applicable, for some as a full requirement and for some as a guideline. But again, it will be applicable only to the IFIs and also mainly to those countries that adopt our governance standards. The countries that adopt our governance accounting Sharia standards, you want to see the detail about it, you can always have access to AOP Footprint Report 2022, which is available on AOP website, which provides detail about each country as to whether and to what level they adopt our standards. Thank you very much, brother. We have a comment from Miftau Dibaba. What is the AOFI and FSB objective to make collaboration in the underdeveloped countries like African countries? Thank you very much for this very important question and very important initiative that we need to take. At our level, we are trying to work. Again, first thing is, obviously IFSB is doing their part and we are doing our part. We have a significant focus on multiple aspects. So for example, most recently we established a coordination committee for the African West and North African region, but it will cover the remaining African regions as well for now. But in future, maybe we'll have two different committees, which are regional coordination committees for AOFI. The purpose of having the regional coordination committees is to engage some very senior professionals and experts from different countries within that region, and to try to find out better ways of working with the regulators and creating awareness about Islamic finance in general and about AOFI standards in particular. So thank you very much. AOFI works with very limited resources. We just pray and we need your support. As soon as we have better resources, we'll try to enhance our work in these areas as well. From our perspective, some of the African countries are very, very significant for AOFI because they adopt our standards fully or partially or as guidelines. And we know that these are the areas where Islamic finance can be used as a tool to have a better economic development. We are fully with you and we will love to explore more opportunities to work together with you. Thank you very much. Individual guidance that you would like to provide, you can send it to me by email. Any comments, any suggestions that you have in this area, you can send to me by email at oansari@aofi.com. Thank you very much again. Now, we still have a couple of hands raised. So maybe Sister Zahra, if we can allow them to speak. Brother Miftau Dibaba comment has been taken. So you can give floor to Brother Hamdullah Hamidi if he wants to say something.
Yes, allowed to talk.
Brother Hamdullah Hamidi, you can speak if you like. Your hand was raised. Okay, Brother Muhammad Arifur Rahman.
Assalamu alaikum warahmatullah.
Wa alaikum assalam, brother.
Thank you so much for giving me an opportunity. This is Muhammad Arifur Rahman, and I am working in an Islamic financial institution in Bangladesh, and that is Islamic Bank Bangladesh PLC. And currently, I am studying at INSEAD in Malaysia and pursuing MSc in Islamic finance. So far as I know, that the investment account, especially restricted investment account, is treated under quasi-equity under AAOIFI regime, whereas in the country or the Islamic financial institution, they're following IFRS regime, they are treated under off-balance sheet item. So yes, I agree to your statement that due to the reporting under following IFRS standard, there is a misconception among the people about Islamic finance. They completely agree to it. And I believe that, yes, if the Islamic financial institution follow the same standard that are provided by AAOIFI, that will be better for every Islamic financial institution and Muslims. So my question is there an exchange offer under this guidance from AAOIFI. And secondly, in my country, in
Sorry, I
my
couldn't hear your first question very clearly. Can you kindly repeat? My apologies.
so my question is that is there any change going to be happen under this governance or guidance
Okay,
about restricting?
the quick answer is that it is going to change significantly the things that are actually happening in the market, and that is the reason that we have started receiving some harsh feedback from some of the management and some of the regulators as well, who feel that it is very difficult. It will make life difficult for them.
Yeah. Yeah, and so one disappointing thing for me, that country like Malaysia, they are just becoming the hub of Islamic finance, but they are not following AAOIFI standard. That is disappointing thing. And for my country, Islamic Bank is the largest bank currently in Bangladesh. But so far, I observed that they do not segregate the restricted investment account or unrestricted investment account. So I think if AAOIFI could take any steps or initiatives that may be useful for
Actually,
that, maybe that may implement the fi- financial institution, or if AAOIFI has any initiative to collaborate with the government of different country to adopt AAOIFI standard, that will be better.
Thank you very much, Brother Arif. I think we highly appreciate your comments. With regard to Malaysia and Bangladesh, both regulators, we are trying to work together with them. In Bangladesh, we are working with Islamic banks and the CSBIB as well, very closely. We are trying to work in a way that all the regulators be a part of the AAOIFI's initiatives in this respect. However, I would like to submit that AAOIFI is the standard setting body and it can support in standard implementation, but the implementation primarily is the domain of the respective regulators. We cannot go to the market and get the things implemented. Yes, we can provide the support that is needed for capacity building and the support that is needed for the standards implementation, to limited to our resources. But the remaining things, obviously, if we can't do it anything on that part, and actually that has to happen according to the respective regulators' approach. Bangladesh is adopting partially our standards and on a guideline basis. Still, they haven't adopted our standards fully. Malaysia have, in some areas, their own standards, and in some areas, they have their own regulations, which are quite good. So Malaysia is already a very well-regulated country, and some of their practices are actually advanced as compared to other markets. But yes, for the global harmony, it is very important that AAOIFI standards are adopted there as well, and we are trying to work closely with the regulator on that part. Thank you very much, Brother Muhammad Arif. But at this point of time, I think I need to move on. We cannot have this discussion going forward. We need to move ahead because it's a very long standard. And we'll try to focus now more on the very specific comments on the standard and its contents, rather than the generalized comments. So that is my just request to you and everybody, that we need to be focused because of limited time. Now, there is another comment from Brother Miftahu Dibaba. Is that okay? So he has some appreciating comments. Thank you very much, Brother Miftahu. And there is a question that he has: how can we work by AAOIFI standard by compiling our national regulations? I think, Brother Miftahu, this is where as I mentioned to Brother Arif Rahman also, that we need to work between the standard setting institutions like AAOIFI and the regulators. So the main function, once the standard is developed by the standard setting body, the next function is in the hand of the regulator to adopt or adapt it in their country and to get it implemented. In that respect, we will highly appreciate if you can support the initiative by getting the things connected through the regulator. Thank you very much again. And now, as I mentioned already, that we need to be more focused on the standard itself, while I would love to answer all the questions which are generally posed as well. But due to limited time and focus on the standard which is needed, I will keep focus now only on the standard related comments. This is standard, Brother Muhammad Arif Rahman, your hand is raised again, or it is continued raising. So if you can kindly remove the hand, that would be better. Okay, thank you very much. And now moving to the standard itself, I have provided some background about the standard already. However, I think I would like to mention one thing that in the objectives of the standard, what we want to achieve is that this standard want to bring how would I put it better, that this standard want to bring multiple improvements on the front of investment accounts. So this standard aims to set out the principles of governance and management of investment accounts held with and other participatory investment instruments having a similar nature to IS issued by the Islamic financial institution. So we are talking about investment accounts and similar instruments, similar participatory instruments that work on a similar model. So for example, some sukuk may be working based on similar model. At times we have seen some tier 1 sukuk which are actually part of the investment account pools. So this standard shall be applicable on all instruments which are either called investment account by whatever name, or which are in different type of instrument but have a structure similar to investment accounts. It is expected that the implementation of good governance practices for investment accounts and other similar PIIs, that is participatory investment instruments, collectively referred to as IEs in this standard, unless context suggests otherwise, through the adoption of this standard in turn would help the Islamic finance industry achieve the following objectives. Number one, improve the overall level of Sharia compliance and respect of IAs. Number two, improve the overall risk management mechanism for IAs. Number three, enhance the confidence of current and potential investment account holders and holders of other PIIs, collectively referred to as IAH in this standard, unless the context suggests otherwise, and stakeholders in IFIs, and resultantly, the mutual sustainability and growth. We are talking about mutual sustainability and growth. That is, the stakeholders and IFIs grow together. They remain sustainable together. Safeguard the reputation of the Islamic finance industry by providing fair and equitable treatment to IEHs, protecting their respective rights in accordance with the best practices of business conduct in respect of consumer protection, and enhancing transparency and disclosure. I forgot to mention earlier this very important aspect of consumer protection. Just keep in mind that consumer protection, particularly a consumer who is a participatory stakeholder with you, that is actually requiring significant ethical conduct, contractual obligations, and fair and just treatments. Promote better governance and structures and controls to safeguard the interests of investment account holders, particularly for the low-risk investment accounts. I'm just going to explain the low-risk investment accounts and high-risk investment accounts shortly. Promote the practices of having high-risk investment accounts with appropriate governance structures and transparency, to promote the participatory investments on one hand, and to provide opportunities for high-risk, high-return investments to investment account holders as appropriate to their respective risk appetite on the other hand. Scope. This will apply to all participatory instruments, including investment accounts based on Mudarba or similar contracts, including without limitation Musharka that represents quasi-equity, including both the HRIAs and LRIs, as well as investments placed by other financial institutions. Al-Wakala bil Istismar arrangements commingled with unrestricted investment accounts based on Mudarba. A participant's investment instrument offered by a Takaful institution if the same is subject to classification as quasi-equity. Off-balance sheet assets under management, for example, restricted investment accounts and al-Wakala bil Istismar arrangements. This standard shall also be applicable insofar as suitable to the following: a sukuk or similar instrument based on a participatory structure issued by an institution, whether or not being an IFI, which means that even an entity that is not an Islamic financial institution, but it issues a similar instrument like a Mudarba sukuk, that should also be applying this standard as insofar as practicable, in addition to the requirements of respective AAOIFI governance standards. Like in case of sukuk, it is governance standard 12. A participants investment fund managed by a Takaful institution not qualified for for classification as quasi-equity, in addition to the requirements of any relevant AOFI governance standard. So now this was our introduction, our objective and scope. Do we have any comments on the objective and scope? I can't see any comments on the Q&A tab. Attendance, alhamdulillah, is now 107. Earlier, I was a bit afraid that it's too low attendance for such an important standard. Okay, now coming to the definitions. Control definition is more relevant to accounting. The purpose of the control definition is to establish what investment accounts remain on balance sheet and what remain off balance sheet. The definition is primarily an accounting definition, is coming from the accounting standard. It says that an institution controls an asset or business when it has substantially all risks and rewards incidental to ownership of such asset or business, duly meeting both of the following conditions. One, it is directly exposed to and has rights to variable returns and negative and positive respectively from its involvement with such assets or business. Or two, it has the ability to affect those returns through its power over the assets or business. There is a table provided in the AOFI FAS 44 to determine control of asset and business, which provides very appropriate guidance with regard to what type of investment accounts and quasi-equity instruments remain on balance sheet and which one gets off balance sheet. So that is not the subject of today's discussion. And that was mainly part of the accounting discussion, which accounting standard already finalized. So that is available in the table of FAS 44, which actually provides guidance on this part. So I do not want to have more discussion on this part, but in a nutshell, would like to say that if the institution controls an instrument and the underlying assets of that instrument, then that instrument remains on balance sheet. And while if the institution does not control, it becomes off balance sheet. Generally speaking, restricted investment accounts and wakala bil istismar are off balance sheet accounts, while the unrestricted investment accounts and the wakala bil istismar accounts, which are commingled with the unrestricted investment accounts, they remain on balance sheet. Demand investment accounts are the investment accounts which are invested without any commitment by the IH for maintaining the investment for a specific period of time with a commitment by the institution to immediately encash the investment accounts along with due profit or loss when demanded. Displaced commercial risk, this is the definition, but in a nutshell, I would say that displaced commercial risk is the risk that if you do not pay according to the market expected rates, people will withdraw their deposits from you. This is in a nutshell. The definition is close to IFSB definition, but it is slightly amended and improved by AOFI for itself. So the DCRF refers to the extent of additional risk borne by an institution's owners in comparison to the situation where the IH assume all commercial risk, including credit, market, equity investment risk, as well as rate of return risk associated with the underlying assets of the respective investment pool, considering the need to match their respective rates of return with the rate of return prevalent in the respective markets, including avoidance of losses to be passed on to them. External Sharia audit definition is coming from other standards. Fiduciary capacity, I would like to mention, is the capacity to act in good faith on behalf and for the benefit of another party with the duty to preserve trust. This is a very important definition. We have put it in other standards also. In case of investment accounts, the institution has a fiduciary capacity, which means that it is the capacity to act in good faith on behalf and for the benefit of another party with a duty to preserve trust. The question is, let me put a question. Okay, Sister Zahra, can we create a poll here?
Inshallah. Tell me.
So I'll like to put 3 questions roughly on the poll, if you can just note them down. So first question is that do you agree or disagree, yes or no, that the institutions, Islamic financial institutions in general, are fulfilling their fiduciary responsibility towards investment accounts in your respective markets?
Okay.
Okay, that would be the first question. Second question, do you agree or disagree that the way that Islamic financial institutions are providing returns to investment accounts is exactly matching and mimicking the way the conventional institutions are providing returns, which creates at times a reputation risk to Islamic financial institutions. This is just a poll to the participants. They can feel free to provide their answers. The third part is, the third question that I would like to pose is that do you agree that there are Sharia issues in respect of investment accounts which are unaddressed? For example, in case of transfer of assets between pools, in case of exit of the investment account holders, in case of profit and loss computation workings, etc.
Brother, can you repeat the last question, number 3?
The last one is that do you agree or disagree with that there are significant Sharia compliance issues in the market practices for Islamic financial institutions with regard to, for example, transfer of assets between investment pools, the transfer of assets, the exit of investment account holders, exit and premature encashments of investment account holders, and the third one was about profit and loss computation for investment account holders, etc.
Okay.
Okay. Just put put a poll of these 3 questions.
Inshallah.
Okay.
Yes.
Let's take a view of the participants. Okay, let me put the 4th question, and that is a very crucial question because some of the regulators and other market participants have come very strong to AAOIFI that they feel that this is a very difficult standard to be implemented. So the question is that do you think that complying with the requirements of this standard will create a hardship for Islamic financial institutions in some cases, and some relaxations need to be provided?
Okay.
Okay. Is it possible in our poll to get examples from people?
I'll check if we can put a space to write.
Okay. No, they do it in the poll. But what we will do that we request everybody that if they feel that there are real hardship elements which suggest them not to put in the poll, but put in the Q&A tab. So we are going to, dear participants, we are going to put this poll to you about these 4 questions. The 4th question has a crucial element with regard to the hardship to the Islamic financial institutions and difficulties in implementation of the standard. So from that perspective, while we would like to have an answer from you with regard to whether you feel more relaxation needs to be provided, or you feel that no, this standard brings the practices to the right level which should be there. So, but in addition to that, if you feel that there are hardship elements, you should try to put some comments in the Q&A tab. In the Q&A tab, particularly, like while we will be going through this poll, can we request most of you, all of you, if you have read the standard and understood the requirements, if you can put like quick short comments in the Q&A tab about this issue as soon as possible, you can start putting it. That if you feel that there are genuine hardship elements in this standard which will be difficult, and you can put them now, and you can put as I take you through the standard. Hiba is the voluntary act of payment of money or transfer of an asset to another party without a consideration. Explanation: in the specific context of the standard, hiba generally refers to any amount voluntarily paid, transferred by an institution, normally out of its share of profit, to IHs as a gift to meet the desired level of IH's fund. Sister Zahra, just a suggestion by myself, just make a note of it. We'll discuss it with the board again. But normally out of its share of profit may better be replaced with out of owner's share of profit. I'm just thinking, just put a comment that whether its share of profit is better or owner's share of profit is better. Okay? Or share of profit attributable to owner's equity. Normally out of share of profit attributable to owner's equity. Okay? Just keep it as a comment. We'll discuss in the working group again whether saying its share of profit is more appropriate or saying out of share of profit attributable to owner's equity is better. Okay?
Yes.
High-risk investment accounts. Now, I said earlier that I'll try to explain. High-risk investment accounts are the ideal investment accounts, which should be the real core of Islamic finance. So we are saying that high-risk investment accounts include such restricted investment accounts and most of the restricted investment accounts which do not meet the definition of low-risk investment accounts. Now, which means that we need to understand the low-risk investment account definition to understand what is high risk. Let me take you to the low-risk investment accounts now. Low-risk investment accounts are the investment accounts offered to the investors at large with lower risk appetite and a safekeeping mindset. Now, if I go to a bank, even Islamic bank, and I put money with the Islamic bank, in my mindset or in my back of my mind, a safekeeping intent might be there because I'm going to a bank, so I want to keep my money safe also. So if you want to keep your money safe, then you cannot put directly for such investment which may result in a significant loss situation. Which means that low risk investment accounts are the risk appetite mindset of majority of the investors. And these are the one at time which have so much similarity with the conventional also. Because any investment account in Islamic financial institution based on Mudarba or similar structures cannot have a guarantee of capital or guarantee of profit. But the way these are designed and work, normally the amount is secured and safeguarded, and even the profit expected is paid through other profit smoothing techniques as well. Explanation. LRIAs include the LR ureas, that is low risk ureas, and similar instruments considered to be quasi-equity, having put option, fixed maturity, and stable and low return expectation with minimal risk of losses. Their other characteristics include that these can be withdrawn on demand immediately or within a suitable notice and processing period and are subject to high liquidity and withdrawal risk. So these are the LRIAs. HRIAs are the ones which are not LRIAs. That the safekeeping mindset is not primary. And Sister Dara, I just received a message that the webinar is streamed live. It was not being streamed live earlier?
It was, brother, from the beginning.
Okay. Just to confirm, because the message was appearing on my screen.
It's appearing for me as well, not sure why, but I accepted from the beginning.
Okay, thank you. Just will have to make sure that the whole of the webinar remains available on YouTube. Okay, now I can see a comment on the Q&A tab by Brother Altijani Ahmed. IAs have main streams, utilization of funds and distribution of profit. How funds are used and profit is calculated. Brother Altijani, your question is very simple, but the answer is a 70-page standard. So you will have to read the whole of the standard to get the answer to your question. Inshallah, I'll take you through the whole standard, the major parts of it. So inshallah, we'll go through all of this discussion. Internal Sharia audit is a standard definition. Investment accounts is a participatory investment instrument, see paragraph 5 commonly capped and operated as a banking account with an Islamic bank or similar financial institution. Investment pool in the specific context of this standard comprises distinct assets whose risk and reward wholly or proportionately are attributable to the funding provided by the respective investors within owner's equity, quasi-equity, and off-balance sheet assets under management of an investment or of an institution. It is generally a virtual entity and at times a separate reporting entity. Now, what we are saying is that the participatory instruments, including investment accounts, they have underlying assets. Those underlying assets are part of the investment pool. That investment pool is a virtual entity, which is a distinct set of assets. So it works as a distinct virtual entity. And at times it can be a reporting entity, but because the owners and the ownership structure of these underlying assets is different from the ownership structure of the whole institution, hence it is technically a virtual entity. This definition is actually coming from our accounting standards, and accounting standards already have addressed this issue. But from the governance perspective, we would like to remind all the institutions that When you have an investment account mechanism, each investment pool is not part of the institution directly. Rather, it's a controlled virtual entity by the institution, which means that the risk and reward incidental to ownership of the underlying assets and the control is actually shared, and the risk and rewards are attributable to the investment account holders and other type of equity which is part of the pool. And this makes Islamic financial institutions significantly different from their conventional counterparts. Brother Mahdi Ahmed has a very good comment on HIBA. I suggest we add discretion of the institution without prior condition. Excellent point, Brother Mahdi Ahmed. This is this is excellent suggestion. I personally believe that it should be added either to the definition itself or to an explanation to that. Thank you very much for a very valuable comment. Ahmed Aslam has a comment. HIPAA is included in the agreements in most of the cases. If it is pre-agreed, such will be Sharia compliance. Okay, brother Ahmed Aslam, the quick answer is HIPAA is never included in the agreement, but it is included at times. It is promised. Even we, AAOIFI Sharia standards and AAOIFI this standard do not allow a pre-promise of HIPAA. So from the comment that you made and the earlier comment made by our respected brother Mahdi Ahmed, I believe that both comments go in the same direction. We need to provide some clarification in this part that HIBA cannot be guaranteed or pre-agreed. Actually, this might not be necessary in the definition. I'm sure that it is covered in the body text. Even Brother Mahdi Ahmed's comment, I can assure you, brother, that the requirement is covered in the standard. The only issue is whether it should be part of the definition or not. But thank you very much, both of you, for very valuable comment. In a nutshell, a pre-agreed HIBA in the view of AAOIFI standards is not Sharia compliant. A pre-agreed HIBA or even a pre-promised HIBA by one party will make the transaction similar to riba. And I can tell you, it was one of our colleagues said that this HIBA is very risky because in the poetry, it can fit on the weight of riba. HIBA can be fit in the rate of weight of riba, because just very minor mistake on this part will make your transaction riba. If I take money from you and I promise to you that I will pay, this makes riba. A pre-promise of HIBA is not allowed by AAOIFI Sharia standard or this governance standard. And we have tried to put some controls on that as well. Thank you very much, Brother Ahmed Aslam, for your comment. And we hope that the standard has the answer to your issue already. Investment risk reserve, again, for investment risk reserve and profit equalization reserve, AAOIFI already have its financial accounting standard 35 on risk reserves. Some of the definitions and related aspects are covered there. In a nutshell, investment risk reserve is the amount appropriated by an IFI out of the income arising from the assets pertaining to relevant profit and loss taking investors in order to cushion against credit risk, market risk, and equity investment risk, mainly pertaining to residual future possible losses after impairment and credit losses accounted for in line with the requirements of AAOIFI Financial Accounting Standard 30 for the respective stakeholders arising from the respective assets and investments. So if we have underlying assets, those underlying assets first need to be provided for impairment and credit losses according to the Financial Accounting Standard 30. Once it is done, still there can be residual risks and some future possibility risk of future losses over a period of time. So that to cover that, an investment risk reserve is suggested to be included. AAOIFI recommends that Islamic financial institutions should follow a investment risk reserve mechanism and profit equalization reserve mechanism instead of HIBA. So if you ask us, we will say never pay HIBA. But yes, for having a proper profit smoothing over a period of time, you should have investment risk reserve and profit equalization reserve. So having better risk management and having better risk reserves is, in our view, advisable and beneficial for the banks and institutions. But paying HIBA from our perspective is against the original concept. And I can tell you that Malaysian Malaysian regulators and their Sharia Council actually discourage paying any type of hiba to investment accounts. And their investment accounts, according to the new regulations that they developed several years back, are more close to the high risk investment accounts and more close to that. Unfortunate part is that because of that, people have moved to the tawarruk based investment accounts, which is worse, sorry to say. So from our perspective, we have recommended that there should be a distinction between high risk investment account and low risk investment account. While high risk investment account should have minimum of profit smoothing, and they may have very limited profit smoothing and no hiba or very limited hiba. But in case of low risk investment accounts, which are for the common public, you should have very good risk management mechanism in place, including PPR and IRR, and hiba may be paid according to need, but according to certain limitations which are provided in this standard. And particularly, I would like to ask all participants today that again, the limitations on hiba and limitations on profit sharing ratios. These are two very important aspects that are included in this standard, and would like to ask all participants here who are actually involved in the computational part and the accounting part, computational part, and Sharia compliance part, and again the management, and if anybody representing being part of the alcos, etc. We'd like to know from you, particularly if you feel that these limitations on the profit sharing ratios and these limitations on giving IBA, which bring the standards and bring the practices closer to Sharia, are they going to pose some significant threat on the working environment and the practicality of Islamic banking? Now, with that, our colleagues have put up this poll. So the first poll question is: do you agree, disagree that Islamic financial institutions in general fulfill their fiduciary responsibility towards investment account holders in your respective market? So this is an agree or disagree question. Secondly, do you agree or disagree that Islamic financial institutions provide returns which exactly mimic conventional banks' returns, which pose reputation risk to Islamic finance industry? Number three, do you agree or disagree that there are significant Sharia compliance issues in market practices regarding transfer of assets, transfer of assets, exits? It's not exist, exits, exits, not exist, sister. So it is exit, means that takharuj or like before premature encashments of deposits, etc. Exits of investment account holders and profit and loss computation. These are examples, but there can be more as well. And if you feel there are more, put them in the Q&A tab. And the last question is: do you think that complying with the requirements of the standard will create hardship for the Islamic financial institution and some relaxation is needed? So put your answer whether you agree or no, don't agree. And in case you agree that relaxation is needed, in that situation, we suggest that you put your suggested relaxation that should be there in the Q&A tab, please. In the Q&A tab, we have a comment from Sheikh Amadou Sissi. Could you please clarify the process for calculating and applying remuneration on investment accounts? We have this part as a section, so I'll take you through that section when we reach there. I keep your question open for now. Islamic financial institution definition is coming from our other standards. Management definition is coming from earlier standards. Monetary assets definition is coming from accounting standard, and this is the one which is used for the purpose of transfer of assets, etc. So I'm not going into more detail. If we need, we'll come back to that. Mudarba is a profit-oriented participation between capital and work. Explanation: generally, in the context of an institution, it is conducted between investment account holders as owners of capital and the institution as a mudarib. The institution announces its willingness to accept the funds of investment account holders, the sharing of profit being as agreed upon between the two parties, and the losses being borne by the owner of the funds, except if they were due to misconduct, negligence, or violation of the conditions agreed upon by the institution. In the latter case, such losses would be borne by the institution. We have a couple of more comments coming up, so let me take those comments. Brother Miftahu Dibaba has a comment. What is difference between risk and uncertainty? I think risk is event will occur in future. Brother Miftahu, my apologies, but it's not a relevant question, so I'll just skip it for now because we will be running short of time. Brother Imran Sultan Khan has a comment as a suggestion. I have a humble suggestion regarding section on I's strategy and policy framework. The section too much focuses on operational specifics like minimum and maximum weightages between different classes of IAs, computation of profit on average balances, and maximum Mudarib share. It suggests that instead of prescribing such specific limit, it may be left on the discretion of RSAs. Brother Imran Sultan Khan, thank you very much for your kind comment. But the question is, even for it leaves it on RSAs actually. It says that these are the suggested unless RSA has otherwise. The point is that if you keep it open only to RSAs, maybe RSAs don't define anything. What happens then? You want it open? You want okay. I have seen from my own eyes, you know, these sinful eyes. These have seen people giving 3 times the return out of hiba instead of that. So the net profit coming was 2% and 8% was given, 6% out of hiba. Do you think it's justifiable? Do you think it's Sharia compliant in its essence? Maybe it in its form, it may be Sharia compliant. But do you think it's in essence, it is Sharia compliant? I have seen the high value depositors taking 10 times the weightage of the low value depositors. Do you think it is justified? It's fair value, it's fair and just. So the question is that if you please, Brother Imran Sultan Khan, please tell me first, do you conceptually agree that there should be fairness in this? Do you conceptually agree that hiba should be limited or not? But if you conceptually agree that there should be limits to that and there should be appropriate weightages, then what we have said is we have given a ratio and we said unless regulator specifies otherwise. And then there are different markets. There are newer markets that adopt AAOIFI standards and they do not have any local experience. So what we have developed is based on seeing what is happening in different countries and what the accounting AAOIFI governance and ethics board considers the working group and the board consider fair and just. So based on that, we have put these ratios and these limits, but we kept it on the regulator. The regulator has full authority to change it according to their market. But keeping quiet on that means that we are afraid majority of regulators will keep quiet on that. Now, what happens? Okay, I have seen profit sharing ratios 20% 20% Rabul Mal, 80% Mudarib. I have seen in workings. Do you think it's justifiable? The money of the investment account holder is at risk, but you give him only 20% of the profit. Try to understand my point, dear brother. This is something where the overall justice and fairness kicks in. This is where the real Sharia compliance kicks in. So, okay, for me, we take the argument of Athulus Kathir in case of screening of investments. So if you pay more than 50% of hiba, do you think it's justified? The majority part is coming out of hiba, not out of profit computation. So if the profit comes out at 7% and the expected was 8%, then if you give 1% out of hiba, while I believe that having a continuous practice of hiba is bad, it makes it, it makes it al-ma'ruf kal-mashrut or al-ma'ruf urfan kal-mashrut shartan. That is that one that you make something as a common practice, it becomes like an implied condition. So do you think that Islamic Bank should continue working this way? While I agree that these limits can have some working problems, but don't you think that we need to improve on the Sharia compliance and the fairness part? So while I fully agree that we understand and we know that market participants feel that there is a problem in this part, but first we need to agree on the conceptual part. Do you conceptually agree? Do you think it's okay that we leave profit and loss computation, whatever number comes, I'll give you 10%? Do you think it's a good idea? This is, for me, at times, it is a very fundamental issue that I need to see that if hiba becomes very normal and whatever difference comes, I pay out of hiba, it means that the whole working of profit and loss distribution becomes irrelevant. If you tell me, Umar, every time I'll pay the promised 4% or 6% or 7%, then okay, whatever working comes out of profit and loss, I'll just do the accrual like conventional bank. And that is what certain Islamic banks are doing. We are afraid of that. So yes, we can consider this part. Now, the second part, as you said that RSA should define these limits, we clearly said that they have to define the limit. We clearly said, but we said that if they don't define, then this is the limit. Because if the regulator adopt our standard without defining a different limit, that it means the regulator is defining the limit that we are proposing. Leaving it open and not mentioning any possible limits would mean that the regulator may keep quiet on that, and which means that the intended benefit that we want to have it here will not be there. And it's not only about this point. The point is we have arguments and we have complaints. We listen complaints from different banks that, okay, the bank return on equity is 80%, 90%, 60%, 40%, and return on equity of investment account holder is 2%. Do you think it's just and fair? Do you think it's Sharia compliant? Again, my dear brother, with all due respect, your comment is very important for us, but we would love to learn more about how the suggested limits are impracticable or are not justified. We would, with regard to the RSA part, that is already covered, that RSAs can define these limits, because we said unless otherwise defined by the RSA, these are the limits. We'll come back to this point and we'll try to improve this part, and we'll try to provide explanation that RSA have all the authority in their respective jurisdiction to define this part. But we do not suggest that RSAs leave it to the institution. Thank you very much for a very valuable comment. Sister, what is the position for the poll? How many people have answered till now?
50%, brother.
Can we request all of you to provide comments on the poll? Because we just would like to have an answer to that as well. Brother Sadaqat, Assalamu alaikum, and thank you very much, sir, for being with us. Mudarib share is taken 80% or more by some banks in UAE as well. Sir, I have seen it 80%. We have seen 80% wakala share in the takaful as well. And the purpose is they feel, oh, we take 80%, then we'll give hiba as much we need. You want to do conventional. You don't want to change your practices from conventional to Islamic. Now, what we have suggested, you put their money at risk and you take 80% of the profit. Is it just? It is fair. Even it isn't Sharia compliant. If you, Brother Sadaqat, you are more learned than me. Sir, if you recall, I think that some of the original studies that we did on Islamic finance, they said Mudarib share, unless specifically agreed, should be generally around 50%, 50 to 50 against capital and work. Some scholars have said that if it is not defined, it would be like this. But the point is that even 50% at times might not be justified fully, because your money is not at risk. Their money is at risk. But Brother Sadaqat, we fully agree. You mentioned that 80% is taken, but you did not mention whether you like it or you don't like it. I hope you don't like it the way you have mentioned. Brother Mahdi Ahmed has a comment. I think we should strengthen the PR and IRR, which are based on profits from investors and IFIs, then strengthening HIBA that we rightly discussed as well. I agree, continuous HIBA will lead to HIBA because of the Islamic legal maxim that applied condition. Thank you very much, Brother Mahdi Ahmed, for your kind comment and support. Thank you very much. Yeah, Brother Sadaqat confirmed that they are playing with profit rate fluctuation actually. So you keep it 80%, you can keep it 99%, and then you give hiba as much as you like. This is, sorry to say, this is not Islamic finance. This is not what Islamic finance is meant for. Thank you very much, sir, for your kind comment. Brother Sadaqat has said that I was always against. That's why they retired you. I'm just kidding, because I still feel you are young. But maybe they retired you because of that. And I know that you are not premature retired, but I'm just kidding. For me, you are still young. The injustice in the Brother Mustafa Abu Bakr has a point. In the injustice in the distribution formula is pushing some to think more of Islamic cooperatives and others as alternatives. Brother Mustafa, I think you have touched a very important point. For me, Islamic banking is not the real solution for Islamic economic system. Islamic banking has to be there. It has to play its role. But as you talked about Islamic cooperatives, actually the capital market solutions, the fintech solutions, cooperative type solutions, these are the solutions that are the real long-term Islamic finance and economic solution. So thank you very much for this comment. I personally agree with this, that Islamic, but it does not mean that Islamic banking is not needed. Islamic banking is needed and it will continue, but I can tell you that the regime and the mindset in which Islamic banking works is dependent on some of the conventional realities as well. So from that perspective, you cannot completely change it. You can improve it. But the real solution you can find in Islamic capital market, Islamic fintech, and Islamic social finance and cooperatives and other participatory structures. Thank you very much, Brother Mustafa. Fully agree with you. Brother Muhammad Ayub has a comment on clause 522. Musharaka-based deposits must be subject to this standard. Currently, SMC special Musharaka certificates are created by banks to circumvent the regulator's bar on giving hiba to single account holder. A part of deposit are governed under SMC instead of Mudaba, so not regulated against the rate. Thank you very much, Brother Muhammad Ayub, for being with us, and thank you very much for raising a very important comment. I can tell you Pakistan has good practice, good regulations. Some of those regulations were considered by us while developing this standard, and we took note of that, and we tried to build upon and improve on that. I personally agree with this thing, and that is the reason that we are not in favor of this thing. For us, high risk investment accounts, which means that a single pool, etc., these things we are actually asking not to be having hiba, etc. We'll come back to this discussion, but fully agree with your comment that this is a way of circumventing the requirement about the limitations. There is comment from Brother Muhammad Tom. The IFS has a fiduciary responsibility towards the participatory stakeholder to ensure their funds are used only in Sharia compliant activities and transactions. It is therefore prohibited for IFS to place funds with conventional financial institutions, either directly or through a third party. Brother Muhammad Tom, thank you very much for being with us. And to be honest, I fully agree with your comment here. This comment is addressed in our Sharia governance standard. It is an investment account standard, so we didn't cover it here. We have covered this issue in the Sharia governance standard. Sister Zahra, I think in the Sharia governance standard, we have mentioned that Islamic institutions should not be investing directly or indirectly in the conventional institutions for placing the funds there. So, and the Tawarruk standard of AAOIFI also is prohibiting that part. So thank you very much for a very good comment. We fully agree. Only issue is whether this comment is linked with this standard and do we need to put it somewhere here, or is it okay, good enough to keep it in the Sharia governance framework? Sister Zahra, keep this comment as an important comment and just put the reference of where we have covered in the Sharia governance framework. Then the working group and the board can decide whether we want to put this comment here in this standard or not.
Clear.
Brother Muhammad Ayub, sir, it is always our pleasure and we always learn from you, sir. It's our pleasure that you are here with us. Brother Sadaqat has another point. Mudarba, the losses being borne by the owner of the fund, except if they were due to misconduct, negligence, or violation of the condition agreed upon by the institution. My comment, better to mention few instances of misconduct, negligence, because the management would never accept their misconduct, negligence, and put on the loss on investment. Brother Sadaqat, here I have a personal very important point. The point is the management will stand up easily and say, oh, it happened because of misconduct, so we will compensate. It's the other way around. So they don't take it. But what happens, one time I raised this issue that, okay, then this should be deducted from CEO salary. Why you are taking it from the owner's equity? You got my point. Because owners appointed the management as their agent to work. Now the agent to work was working on behalf of the principal and he was negligent in doing the function. Since he was negligent in doing the function, so the profit to investment account holders came less. So they compensated, oh, we did not do it properly. So they compensated the investment account holders of the difference. Now, what happens that the investment account holder is compensated? Out of whose money? Out of shareholder money. Okay. But what happens? Was the shareholder at fault or in negligence, or is what the management in negligence? So for me, it needs to be compensated by the management, not by the owners. Sister Zahra, just make a note of this point that I have just mentioned. I think we touched upon something very briefly in the standard, but we might need to address this point as well, because this negligence is a tool in the hand of the management to make it like riba. I can tell you, oh, there is a loss. Since we were at fault in assessing the credit worthiness of the customer, so we take all the loss because we were negligent. Okay, thank you very much. If you were negligent, then pay out of your pocket, because owner appointed you as an agent. Owner was not at negligence. So why you are taking stakeholder owner's money and giving it to participatory stakeholder like investment account, and you are enjoying your bonuses? Brother Sadaqat said, Dr. Hussain Hamid Hassan, Allah bless him, rahimahullah, was of the view that such losses should be covered from the management. Brother Sadaqat, wallah, as a person, I would say it's, I'm so happy to hear that his view was like my humble view. Or I would say that, it's a small coincidence that my humble view is equivalent to that of such a great scholar. But I fully agree with this view, and this is my view also, that you cannot just take it out of the owners, because owners are also not at fault. They appointed you as an agent. Thank you very much, sir. Thank you very much, sir. And we always learn from your great and rich experience. We have two more comments which are a bit like, bit not fully relevant, and it's a long standard, so I need to push the discussion. Off-balance sheet assets under management include assets held, managed, administered, or otherwise dealt with the arrangement or that gives institution a fiduciary responsibility but not control. This definition is also from the accounting side. Off-balance sheet participatory instrument is also coming from the accounting side. Off-balance sheet items is also coming from the accounting side. Off-balance sheet participatory investment instruments also coming from the accounting definitions. Now, this is an important definition. Participatory investment account instrument in the specific context of this standard include all instruments, particularly including investment accounts, whereby the investors are entitled to take the profit and bear the risk of loss, and are entitled to a residual interest in the underlying asset or business, commonly referred to as an investment pool, in line with Sharia principles and rules. These are normally based on Mudarba, but also include structures based on Musharka, Al-Wakala, Bil-Istismar, and certain hybrid structures. Participatory investment instruments may be divided into two main categories. First, where the institution controls the underlying assets, which are classified as quasi-equity instruments. Second, where the institution does not control the underlying assets and manages the same in the fiduciary capacity, which are classified as off-balance sheet investment instruments. This is a very crucial definition, which is very comprehensive and covers multiple aspects of different type of instruments. Participatory investment stakeholders definition is also coming from the framework of accounting. Participatory structure coming from the FAS 44. Profit and loss computation period. Profit and loss computation period is the period at the end of which the respective profits and losses of the respective investment pool are calculated, and the liquidation, normally being constructive liquidation and attribution of profits and losses to respective stakeholders, take place. Explanation. Normally, a PLC period. Sister Zahra, just a consistency about normally whether N will be capital or not. Just see for the consistency purposes, what is our practice.
Inshallah. Right.
And normally a PLC period is shorter than a financial reporting period of the institution, and in practice is normally a month or a quarter. In case of short duration investment, for example, a week, it may be limited to such period. Profit equalization reserve definition is coming from earlier. Sister, this is coming from earlier standard or not? I think it should be coming from FAS 35. Just check it. If it is coming from FAS 35, then there should be. Yeah, if it is not coming FAS 35, then we need to map it again. Profit sharing ratios in the specific context of this standard include the ratios applicable to the working partners, that is the Mudarib share in case of a Mudarba contract or the working partner share in case of a Musharaka contract, and to different classes of IAs and where applicable to the other commingled fund in line with the requirements of this standard in a specific investment pool. Brother Mohammed Ayub, I would like to put a question to you because you raised this issue of Musharaka being excluded and Musharaka certificate covered separately. Don't you think that after putting these definitions and scope inclusions and this profit sharing ratio also addressing this issue, do you think this issue may be resolved, as you were feeling that people create separate pools and all like for one musharaka to get out of the investment account related requirements? So just have a look at it and please let us know that if you feel that it resolves the issue, or if it does not resolve the issue, then you can kindly make some better suggestions to cover where we can cover this issue. Thank you very much. The issue that you raised was very important. We don't want any loopholes to be there, and we want this to be handled properly. For our perspective, if there is an investment pool separately, still that will be subject to the requirements of this one, because the requirements of this standard with regard to the PSR and with regard to the HIBA and others are actually adjustable, are actually applicable at the investment pool level. Brother Sheikh Amadou Sissi has another comment. Funds from non-compliant operations must be purified, which means they should be given to charity or used to social causes. Can the bank use these funds as HIBA for smoothing returns? The quick answer is no. Public interest institutions are the institutions which are either listed banks or financial institution, or their securities like Sukuk are listed, or if they handle the retail customer base, at least we have given a number of 10,000 customers, but the respective regulator can change that number of 10,000. Sister Zara, just make a note of it. Normally now we are using the term RSA instead of regulator. So even in this standard, we need to align it before we finalize. So for all the places in this standard where we have used the term regulator, we'll have to align it with the term that we are using now, that is RSA.
Yes.
We have a comment from Mahavi Ismail. Excuse me, I want to ask Mr. Ghulam Muhammad Abbasi, Director Islamic Banking Department of ISPP. I'm asking whether I can send him through his email short. Okay. He has some comments. So Brother Mahavi Ismail, my suggestion is that you can send a message to him directly through the chat window instead of the Q&A tab. So in the chat window, if any participant want to give a comment to a specific panelist, etc., or want to contact any specific panelist, they can just go to the chat window and select the person who they want to communicate with, and they can give a direct comment to them. So that is the easier way. If you would like to do it, that is easier. Thank you very much for being with us, sir. In the meanwhile, I can suggest Sister Zahra that since it is in the Q&A tab, you can copy paste this comment and pass it on to Brother GM Abbasi for the convenience purpose.
No problem.
There is a comment from an anonymous attendee. Sometimes IBs have a higher share to the Mudarib, but the practice of distributing weightages affects the investment account holders. Unfortunately, IHs are unaware of the impact these weightages have on their fund. There should be clear guidelines for determining weightages. First thing, I always request that anonymous attendees can kindly put their names, rename themselves in the Zoom, or otherwise they can put their kind name and institution name in the comment itself. It is always helpful because all these comments are taken to the working group and to the board. The quick answer is that we have tried to provide all these guidelines with regard to communication, etc. These are all included in the communication part and the computation part and the policy part. But still, if you feel that we have missed out something more specific, we would love to have that specific comment. But generally speaking, what you are asking, we have tried to cover it already. As I discussed earlier, because of a very long standard and limited time, we are already at crossed 50% of the time, and we haven't not yet passed the definition section. So from that perspective, I would like to just mention that I will be ignoring any irrelevant comments, please. Quasi-equity definition is coming from the quasi-equity standard. Reserve definition is coming from FAS 45 accounting side. Restricted investment accounts are the investment accounts where the investment account holder being fund providers authorize the institution as Mudarib to invest the funds on the basis of Mudarba in a specific underlying asset or a specific investment pool of its underlying asset, whereby the discretion of investment or financing decision of the institution is limited. We have tried to explain even this part in this standard as well. Sharia principles and rules definition according to the hierarchy is coming from our multiple standards. Senior management and standard is already, senior management definition is already appearing in multiple of standards. We are taking it from there. Tangibility requirements are important with regard to the transfer of asset between investment pools. And it is covered in the transfer of asset accounting standard as well. Those charged with governance is the term that is used by standard setting bodies like AAOIFI and ISBA. We use the definition from ISBA, which is with regard to which include the board of directors, its committees, and other equivalent bodies in the institution that are having the eventual governance power. Time-bound IAs are the investment accounts which are invested in with a commitment by the IEH for maintaining the investment for a specific period of time with or without early encashment options subject to specific terms and conditions. So there are demand IAs and there are time-bound IAs. Transfer of asset in the specific context of the standard is the transfer of asset from one investment pool to another, whether on balance sheet or off balance sheet by way of either sale, exchange, investment, clearing, or other. For example, if in line with the contractual arrangement or through reconstitution of multiple investment pools immediately following their constructive liquidation in line with the requirements of Sharia principles and rules. Unrestricted investment accounts are the investment accounts that do not meet the definition of restricted investment accounts. With this type of account, the investment account holder authorizes an institution to invest the account holder's fund in a manner which an institution deems appropriate without laying down any restrictions as to where, how, and for what purpose the fund should be invested. Under this arrangement, an institution can commingle the investment account holder's fund with its own fund or with other funds of investment of Islamic Bank has the right to use, for example, current account. The investment account holders and the institution generally share the returns on the investment funds. And weightages. In the specific context of this standard, reflect the contractually agreed weights applied as per agreed profit and loss computation mechanism to the average balances of different IAs, classes of IAs within an investment pool for the purpose of profit attribution and distribution for a specific PLC period, profit and loss computation period, resulting in weight factored returns allocated to such IAs. Note that term weightages as used in this standard shall not be confused with the term weighted average balance, which is used as a common arithmetical term and is a method of calculating average balances. As such, weighted average balances reflect only a mathematical result without any subjective element, while the applying weightages, on the other hand, is a systematic method of assigning returns attributable to different balances. Now we completed only the definition part. It gives me worries that whether we'll be able to handle this standard in one public hearing or not. So now coming to the core principles. So the core principles of governance applicable to all investment accounts include Sharia compliance, fairness, fiduciary responsibility, whereby an institution as a whole and its organs of governance and management in particular shall ensure that appropriately discharge their fiduciary responsibilities in the capacity of Mudarib, working partner, agent, etc., towards all stakeholders, including investment accounts in different classes and categories of investment accounts, for example, common accounts versus treasury IAs or high net worth IAs. Which means that we are not talking about between shareholder and IAs. We are talking about between IAs classes as well. In an unbiased manner, particularly emphasizing or determining of profits and losses in line with Sharia principles and rules, regulatory requirements, contractual arrangements, financial reporting requirements, and customary practices in the same hierarchy. So it's a very important point that you need to apply the Sharia requirements, contractual requirements, regulatory requirements, financial reporting requirements, and customary practices. And the hierarchy shall be as per provided here. This shall include the mitigation of risk of conflict of interest with regard to different stakeholders. So you cannot just give more return to one stakeholder arbitrarily if it is not worked out properly or if it is not attributed according to the proper governance practices. Accountability, risk management, there should be appropriate risk management mechanism for IAs. Internal controls, there should be very appropriate sound system of internal control should be implemented, putting all the Sharia compliance controls and all these requirements. Transparency and disclosure is very important, which covers the financial reporting disclosures as well as the non-financial reporting disclosures like reporting of weightages, etc. Responsibility, where the institution and its organ of governance management shall function in a responsible manner. Investment strategy must be there. There must be a proper investment strategy in place. Proportionality principle is also part of the core principle that depending on the size of the institution, some relaxation may be provided by the regulators, depending on or additionally according to the complexity and risk profile of the institution, things may be adjusted. So some of the requirements of this standard may be very complicated, but they should not be adjusting the things they should not be impacting the things with regard to the type of institution's functionality. So if an institution is very small or very less complicated, some of the proportionality principle relaxations may be provided. Code of conduct and ethics, all these practices must be done with a very ethical approach, and AAOIFI already has code of ethics. Now, there are some additional considerations for high-risk investment accounts. So the transparency and disclosure requirements for high-risk investment accounts would be more as compared to the low-risk investment accounts. Similarly, the investment strategy for high-risk investment accounts shall be more complicated as compared to shall be more detailed and more comprehensive, not complicated, more comprehensive as compared to the policy related to low risk investment accounts. So these are the additional considerations for that. Now, which are the organs of governance and management which are applicable? So those charged with governance have their own responsibilities, and there are governance organs reporting to those charged with governance, including internal audit and internal Sharia audit functions. Then we have the Sharia Supervisory Board. Then we have the management, including senior management, the respective management committees, etc. And management also include the compliance department, risk management department, and Sharia compliance department. Then we have the external auditors and external Sharia auditors. They are also part of the overall governance mechanism. Particularly, external Sharia auditors are not mandatory in every country, but for public interest institution, as per AAOIFI's new standard, they will become applicable after 3 years. So wherever they are applicable, they will be also part of the governance organs. Now coming to this section on IA's strategy and policy framework is a very comprehensive section. And this section talks about that what need to be documented and what need to be done and what need to be part of the policy and strategy to have Islamic finance investment accounts. So an institution shall have in place an appropriate strategy and policy framework. And now we are saying IA's strategy and policy framework as a single document, which complies with multiple sections. So we are not saying strategy is different and policy framework is different. We are saying that strategy and policy framework are to be aligned together and have to cover all the aspects that we are covering in this part B. Sister Zara, I think I would like to stop here and would like to take the comments on the poll. So what is the position of the poll? How many people have responded?
It's 65 out of 90. So I will end it now so you can see.
Yeah, you can, okay. Just close the poll for now. Let's take an answer because other participants may not have this comment. So do you agree or disagree that Islamic finance, the first one is, do you agree, disagree that Islamic financial institutions generally fulfill their fiduciary responsibility to our investment account holders? So we have a majority of 63% saying that the fiduciary responsibility is fulfilled. The second part is, do you agree or disagree that Islamic financial institutions provide returns which exactly mimic conventional bank returns, which pose reputation risk to Islamic finance industry? So 2/3 of the people, that is 66%, are saying that they agree. The third question is, do you agree or disagree that there are significant Sharia compliance issues in market practices regarding transfer of assets, exits of investment account holders, and profit and loss computation? 89% of the participants actually said that they agree that there are significant Sharia compliance issues. Do you think that complying with the requirements of this standard will create hardship on the Islamic financial institutions and some relaxation is needed? The answer of 53% of the participants, roughly 53% is more than half, 47% say that no. Those participants who have said yes, some relaxation need to be provided. One of the comment we received with regard to relaxation, with regard to weightages, etc., to be kept in the hand of the regulator by one of our colleagues. That was already addressed. It will be taken to the working group. If you are requested, you all are requested who have said that there should be some more relaxation. All of you are requested to provide the specific requirements where you feel more relaxation should be there or some relaxation should be kept in the hand of the regulator. So please provide your more specific comments today through the Q&A tab, or you can send these in writing to our team at governance@aoifi.com. Thank you very much for taking part in this poll. And we are close to only one question is like, the fiduciary responsibility part is the question only where I feel that my personal answer would be different. Otherwise, I think the majority related points, I'm close to what, personally close to what the majority is saying in most of the areas, including I personally agree that a bit of relaxation might be needed in some of the areas. Now, development of investment accounts strategy and policy framework. An institution shall have in place an appropriate strategy and policy framework in respect of governance and management of IAs in line with the requirements of this standard, other applicable AAOIFI GSs, relevant regulatory requirements, and Sharia principles and rules, including AAOIFI Sharia standards. Considerations during the development of IAS strategy and policy framework. The IAS strategy or policy framework shall be developed in accordance with the requirements of the standard, relevant regulatory requirements, and Sharia principles and rules. The IAS strategy and policy framework shall be well defined, duly vetted by SSB, and approved by those charged with governance. Which means that this whole document, which is more like a manual, it is to be vetted by the Sharia board and approved by the board. Consideration during the development of IAS strategy and policy framework. Continuing, the IAS strategy and policy framework shall be developed in a manner that the practices of offering HRIAs in addition to LRIs shall be encouraged instead of offering only LRIs, only LRIAs, in order to follow the true spirit of Islamic banking and finance. So we are recommending that your strategy should include high-risk investment account, which is close to the essence of Islamic finance, but it is recommended, encouraged. However, this shall not compromise the considerations related to risk appetites of the IHs and different classes and type of IAs in line with the requirements of the standard. Components. So what are the components of this whole framework? The first one is about the section about the solicitation of funds of IAs and specific prerequisites. So each of these requirements is covered in this standard. So we have the paragraph references in front of that. Investment account risk management policy. Creation of investment pool and identification of segregation of funds and assets, commingling of funds, priority of investment of funds, determination of PSRs and weightages for distribution of profits, movement transfer of assets between investment pools, tangibility criteria, profit and loss computation, attribution and distribution, profit smoothing, capital protection techniques and maintenance of risk reserves, promotional gifts and prizes, investment accounts, takaful schemes, what we call conventionally as deposit insurance, termination, early redemption, transparency and disclosure, internal controls relevant to investment accounts. This is the part of this is what we need to cover in the policy framework. But most of these sections which have different stages, so the standard is developed in a way that first we have covered what is in this policy framework, and then we have covered in different stages what needs to be done. And as I mentioned already, it's a quite detailed standard. Now, we just received a comment from Sheikh Sam Salki. The poll practicing excellent to clear concept. Please, if you can send a questionnaire for each draft, it will be must hopefully. Thank you very much, brother Sheikh Hisham. Sister Zahra, I believe for this standard, we are going to do a survey as well, depending on some of the initial comments that we received. Am I right?
Yes.
Okay.
Yes.
Okay. Sheikh Hisham, inshallah, we will be doing it. Just make sure that Sheikh Hisham is included in the survey questionnaire that we will be sending. May I request all of you who are participants today who want to be part of the survey that we will be conducting specifically on this standard with regard to certain specific aspects, can we request all of you who are interested to provide your email addresses or your names quickly in the chat box. So our team will take note of your names, and as soon as we are in the phase of survey, we'll make sure that you receive that survey questionnaire, inshallah. It will be done mainly online, but will be like, if we have your, again, we will be selecting experts, regulators, institutions according to our own lists. But anybody who want to be part of that, please feel free to provide your name here. Inshallah, we'll make sure that you are included. Thank you very much. So with this, we move to the next section, components of a IA strategy and policy framework and significant considerations. So all the consideration between 16 to para 57 that I mentioned, these are to be covered while developing in the investment accounts policy. I think, sister, we have to take a break at 12. Am I right?
Correct, brother, for prayer. Yes, 15 minutes.
Yeah. I think we need to take a short break because the time is limited. So we can take only a break of 15 minutes or maximum 20 minutes. Okay, let's take a break of 20 minutes now. We are not even halfway done, much less than halfway done, and remaining time will be less than half, but still a break is necessary for prayers and stretching our legs. So just I would just quickly stop here, and we'd request all of you to keep connected. We'll be joining back in 20 minutes. It's 11:58, so like 22 minutes, 12:20 of Bahrain time, inshallah. We will continue again. Thank you everybody for being with us, and we hope that you continue after the break as well. After the break and prayers, etc., we'll join back, inshallah. Thank you. Just Assalamu alaikum, everybody. Shall we start? Okay. Bismillahirrahmanirrahim. Welcome back, everybody. And with your permission, I'll share the screen again. Just a request. I think we have on the webinar chat, there are some requests about full recording of the session. All AAOIFI public hearings are available on YouTube. They are all on AAOIFI channel. They are live streamed at the same time, and then they are kept as a record. So probably it will never. You can always find. Sister Zahra, if you can just confirm to the participants individually as well about the link of the presentation today. With that, I'll share the screen. Okay. So there is a comment in the Q&A tab. Okay, thank you, Sadaka Sahab, again. Now we are talking about the components of IAS strategy and policy framework. So we have gone through the list. Now we are going through one by one on each item. So the first item is about solicitation of funds for IAS and respective prerequisites. Just one thing that came to my mind during the break, let me mention it right now. Normally we conduct 3 public hearings on each of the standards. Today I feel personally that we will not be able to complete the standard in the detail that we have discussed the initial sections. It won't be possible to discuss all of the remaining sections in that much detail, even half of them. So what is coming to my mind is that for now, we cover definitions and components of IAS strategy and policy framework section in detail, like we are doing right now. And then for remaining sections, we take a brief and we take comments. In the next public hearing, which should be also roughly of the 3.5 hours, we'll cover this section very briefly, these 2 sections very briefly, and then we will cover the remaining sections in quite detail. And the last public hearing, we can try to keep it a bit longer and try to cover all of it in moderate detail. This way, actually, I think we'll be able to handle it. Otherwise, it needs more than 3 or 3.5 hour time. I can tell you that it needs maybe like 6 to 7 hours based on the speed that we are discussing it right now. So with that, I think that if you all agree, we keep this approach that the first public hearing addresses the definitions, initial section, and the part B in detail and other sections very briefly. The next public hearing handles part A and part B briefly, and then remaining sections in more detail. And the last public hearing, whole of the standard again in moderate detail. This way, some of you who may be able to attend the other public hearings, particularly those who attended today, we request them to attend the second public hearing in particular as well. Sisters, it will be good if we can register today's participants for the next public hearing as soon as we announce it, so that they are able to cover the whole of the standard. But again, if you have comments on any section of the standard, you can provide those comments to us right now. So with that, I'll take you through this section. So the first section is about solicitation of funds. So when you start asking people, soliciting people to bring funds under investment account regime, you should have the following requirements. An institution shall not launch a public solicitation of funds for IAS and their respective classes categories unless it has A, ensured compliance with the requirements of the standard, particularly with regard to development and implementation of IAS strategy and policy framework, as well as pre-commencement considerations, which are in section in paragraph 68 to 73. Then it has secured necessary approvals from the SSB with regard to the respective product. Sister Zara, I think here product should be in bracket S. So it can be singular or plural. Okay. Secured necessary regulatory approvals and has made necessary arrangements for commingling of its equity as applicable and identification of segregation of underlying assets of the respective investment pools. So that is part 1. Now the second part, IAS risk management policy. An institution shall develop specific aspects of the risk management policy related to IAs in line with Sharia principles and rules, the requirements of the standard, relevant regulatory requirements, and the global best practices. Here we are talking about global best practices, particularly with regard to the capital adequacy, with regard to the risk assessment, risk management. Those are which are issued by IFSB. So we are particularly considering IFSB standards to be global best practices for this purpose. And obviously the regulatory requirements. So the risk management policy should address the specific risks which are related to investment accounts, and it actually cannot be done through just copy pasting or the conventional risk management policies for from the conventional side for deposits and investment deposit accounts related. Risk management may not be exactly attributable. For example, rate of return risk for Islamic finance is different from the interest rate risk of the conventional finance. Similarly, the risk management of profit smoothing, displaced commercial risk, etc. These are the things where you need to have your specific policies. The risk management policy shall include in particular considerations with regard to the management of the rate of return risk and displaced commercial risk. It shall also include the considerations for the management of the fiduciary risk, being the risk of failure to comply with the fiduciary responsibilities. Firstly, the risk management policy shall cover the approach as to how these risks shall be managed through careful solicitation of funds for IAs and appropriate planning and projections, appropriate identification and segregation of underlying assets, management of risk related to underlying assets, including credit, market, equity investment risks, as well as where appropriate related operational and business risks. Better management of liquidity risk, including liquidity profile management and matching and other ancillary risks. So this is what we are saying, that this is the context of the investment account related risk management policy, which is not exactly similar to conventional. So you must have a proper policy framework for a risk management policy in place before actually you commence your operations. Secondly, but no less importantly, it shall cover the approach towards managing these risks, particularly displaced commercial risk, including profit smoothing techniques, for which we have a separate section as well. Okay, we have a couple of hands raised. Okay, this is only one person hand raised 2 times. That is Brother Miftahu Dibaba. Brother Miftahu Dibaba, can I request you kindly to put the comment in Q&A tab? Because of limitation of time, we have to stick to this approach. My apologies, but normally as a matter of policy, we allow people speaking only if the time permits it. Unfortunately, today the time is limited, so it will be very difficult for us, but your comments will be addressed in Q&A tab. One more important thing is that just keep in mind that when you put your comments in Q&A tab, they remain available for our record purposes, because all these comments are to be taken to the working group and to the board. While if you speak up only, then obviously it depends on the team's effort to capture your comment and write it down. So just a request, please put it in writing in the Q&A tab. The third section related to this area is creation of investment pools and identification and segregation of funds and assets. An institution shall ensure to incorporate inter alia the following considerations while creating the investment pools for IAs. Insofar as practicable, the number of investment pools shall be kept at a minimum to avoid complexities and to address Sharia compliance, fairness, and equity-related issues. Explanation: a single investment pool for IAs may be preferred in most circumstances. Now, this is a very important issue. While some banks have only general pool or limited pools, and we have seen this thing, but there are practices of some banks who have a large number of pools. Now, they use these large number of pools to circumvent some of the requirements of the local regulatory framework or some of the Sharia requirements, etc., which we have seen. The problem is that if you increase the number of pools, the complexities with regard to the transfer of assets, fungibility, so many different issues, they actually increase, which result in a situation that we end up having a huge, risk of Sharia non-compliances, and at times there are additional risks with regard to challenges. And not only this, the problem is you created one pool for one customer having only 3 assets. Out of 3 assets, one defaulted. What will happen? The whole pool will go in loss. Larger pools actually apply the portfolio theory as well, which means that the larger pool average out the risk of loss and reduces the huge risk of losses to the whole pool. This is the reason that we are making a very clear recommendation here that this should be done in a manner that minimum pools should be there. This is where I would like to particularly request the experts who are actually in the field and working in this area, whether they understand and agree with the observation that we have made and the recommendation that is made by the standard, or they feel that it will create some problem. Again, this is insofar as practicable, we are saying. We are not making it mandatory. It means that if there are practicality considerations or issues, you can still keep multiple pools. Brother Sadaqat has another point. Risk management should also include Sharia non-compliance risk. Sadaqat Sahab, you are absolutely right. In generally speaking, risk management, where we have covered in our Sharia governance framework and other places, we covered the Sharia non-compliance risk part as well. But here we did not cover it from that perspective. But now, after your comment, I feel that we should have covered at least this aspect, that specific Sharia non-compliance risk related to investment account should be covered in this risk management policy. So again, Sadaqah Sahab, thank you very much. We always learn from your experience and your comments. So my personal comment would be in agreement with your comment that when we have talked about the risk management policy, so we should be talking not the Sharia non-compliance risk in general, but the Sharia non-compliance risk with regard to the tangibility, with regard to the tradability, with regard to the transfers, with regard to the exits, with regard to the profit and loss computation, etc. The Sharia non-compliance risk is specific to the investment account related functions that should be covered. So thank you very much. Highly appreciated your comment, sir. And my comment will be in favor of your comment. So inshallah, we'll try to incorporate that part in the risk management section. Sister Zahra, please make a note of it, and my response also, please. Brother Muhammad Ayub has a comment on paragraph 21 on pool. The unnatural number of deposit pools are to separate pool for high net worth depositor in case he wants high profit. Standard may provide any specific guidelines on to the regulators in this respect. So I think Brother Muhammad Ayub's comment. I think Brother Islam Ahmad, you responded to that, so that's why it actually got out of my list. So I can now see it as in the answered ones. So, I think standard may provide. So Brother Ayub, the question is, standard may provide any specific guidelines for the regulator in this context. So what do you want? You suggest regulator should not allow it, or regulator should allow it, or what regulator need to be considered? Can you kindly a bit more explain your comment? Because as Brother Islam has already responded to your comment that it is generally included. But is there anything very specific in your mind? Then please let us know additionally. Thank you very much, sir. Insofar as practicable, constitution of short-term time-bound investment pools shall be discouraged to avoid increased possibility of non-compliance of Sharia principles and rules and requirement of the standard. Authorities of related functions shall be expressly defined for the creation and management of a new investment pool. Each RIA offering shall be kept in a separate investment pool and appropriately ring-fenced. This is a very important point, that restricted investment account offerings, we are suggesting that they should be appropriately ring-fenced. They shouldn't be mixed up and commingled. So they should be kept, and each RIA offering shall be kept in a separate investment pool. This is something that we believe that it is because of the nature of the RIA, because the RIA requires investment in a specific asset or a specific pool of asset. So from our perspective, our understanding is that all RIAs must be according to each offering, they must be kept in a separate pool. Secondly, since they are specific to those assets according to the instructions, so they should be appropriately ring-fenced. HRIAs, considering their risk appetite and target asset classes, shall be kept in one or more separate investment pools commensurate with the respective risk characteristics. So in case of HRIA, if the risk characteristics are different and if the target asset classes are different, in that situation, you can have multiple pools, or we should rather have separate pools. Otherwise, you should try to keep it in one pool. Each investment pool shall be considered a fully segregated virtual reporting entity and shall be subject to appropriately segregated bookkeeping and financial reporting in line with Sharia principles and rules and reflecting the respective rights and obligations of various parties in accordance with the requirements of relevant AAOIFI financial accounting standards. Now, this F, for me, it is a fundamental. You need to do it. But we know that some of the institutions will have problem for this, mainly because of IT systems. So my specific question to all of you is that if you feel there is any other approach other than what we have written, is there any appropriate approach, any other solution to this Sharia compliance challenge other than what we have written here in respect of 21F, particularly if you can provide any comment on that part, it will be highly appreciated. Now we move the second next para. Each investment pool shall be created by an institution by the institution. Sister Zahra, here it should be the institution, subject to special constitution documents. Okay, sorry. Okay, Sister Zahra, I think the word it should be read as the correct. It is not wrong, but better to be read as each investment pool created by an institution shall be subject to. Okay, so shall be moved to after an institution. So it's okay. It will improve the wording. Okay. So each investment pool created by an institution shall be subject to specific constitution documents, for example, investment pool creation memorandum incorporating at least the following. So we are saying that whenever you create a pool, it should not be done on a post facto basis. Oh, we just do some number crunching and we did it. Okay, put it here. No, it need to be done in an appropriate manner by having a proper sort of pool creation memorandum or some other document that you need to do. Incorporating at least the following: A, identification and determination of underlying assets, target asset classes, etc. Identification of risk appetite of the IAs and the risk characteristics of the underlying assets, particularly clarifying nature as LRIA or HRIA. Identification of intended tenure of the investment pool, for example, time-bound or ongoing. Identification of income streams, etc., particularly if the investment pool includes service revenues as well. Underlying Sharia compliant contract, for example, restricted mudarba, unrestricted mudarba, al-wakala bil istismar or musharaka, along with principal terms and conditions. Summary of profit and loss computation and distribution mechanism, particularly where the mechanism is different from other investment pools and general policies applied by the institution in this respect, including profit sharing ratios, weightages, and mechanism of change in PSRs and weightages, limits on PSRs and weightages in line with this standard and in line with the regulatory requirements. The expectation of HEBA and limits thereon, the creation of reserves, etc., in line with the relevant requirements of this standard. So these are the requirements which should be mentioned in this one. Sister Zahra, after F4, it should be semicolon, not a full stop, because it's continuing as G.
Continuing.
Okay. Accounting policies and related aspects only when different from the normal accounting policies of the institution. For example, charging of allowance for impairment and credit losses, fair value gains and losses treatment, or any other accounting adjustment to avoid accounting mismatches, etc. Comma before etc. Sister.
Yes, brother.
Currency of investment pool, and in case of multiple currency IAs to be offered when allowed under Sharia principles and rules, the translation mechanism into or from the currency of the investment pool, ensuring that such translation does not result in any manner whatsoever in partial or full guarantee of capital or any other Sharia non-compliance. Now, this currency of investment pool issue is also a very significant issue that we have seen in our in the market practices, and we feel that this is a huge issue that need to be addressed by the industry. Brother Sadaqat has a comment: is it appropriate or possible to add list of investments of type of investment which must be considered non-Sharia compliant and IFI should refrain, including those in the pool? Brother Sadaqat will take your comment to the working group and we'll try to see if we can do anything. I personally immediately don't see anything here because we have talked about the assets and the target asset classes, etc. And it is assumed that Sharia non-compliant will not be there. But it's still we'll take your comment and we'll see at the working group level if it can add value. Thank you very much again, sir. I was talking about this currency of pool issue. Brother Muhammad Ayub has another point. Regulator may allow any categories maximum 7-8 of the deposits like low risk, high risk, individual banks and this. Brother Ayub has a good comment. Brother Ayub, I agree that we can put it that regulator may allow maximum categories for this purpose. So I think we can add a comment here for the regulators that they can assign the types of the pool according to which it can be done. We don't want to do it. Even for Brother Ayub, I think for foreign currency, there can be multiple foreign currency pools. It is possible that British pound and UK and US dollars may not act in the same direction. So even one foreign currency pool might not be enough. For each of the foreign currency pool, you might need to work differently. Thank you very much, sir. But this is a good comment. I think we can provide it directly in the body text, or we can provide an explanation or basis of conclusion on that part. This currency of investment pool, this is a very significant Sharia non-compliance issue, because the problem is that particularly in the countries where the currency is not packed, in some of the currencies which are packed with the US dollar, etc., in those countries, this effect may be ignored. But the countries where the US dollar or the foreign currencies have a huge fluctuation over a period of time, any mixing up of the or commingling of multiple currencies in one pool at times, if not appropriately addressed, result in guaranteeing the capital, which means that it becomes Sharia non-compliant. There are multiple issues in that. There is AAOIFI Sharia standard on Musharka, which clearly says that currency of shirka should be well defined. And we believe that the same analogy applies on the Mudarba and other investment account-based products. Commingling of owner's equity, other participatory stakeholder fund, including funds obtained under a different contract, for example, Al-Wakala business smart funds commingled with Mudarba, etc. And any specific liquidation mechanism for the investment pool, particularly in case of time-bound investment pool, for example, mechanism in passing for transfer underlying asset to another investment pool or to the owner's equity. So all these things are very relevant that should be defined. And I haven't seen any single Islamic financial institution in the world that has done half of it. And we understand that it will create some hardship, and it may be like creating some problem for the institutions in the beginning, but for sure it is going to improve the level of Sharia compliance and handling of the interest of the safeguarding of the interest of the stakeholders. We have comment from our dear sister Amal Al-Masri. Welcome, sister. I think it is very important for the investor to disclose rate of PR that the bank intends to direct from depositors' profit due to maybe depositor withdraw the fund if the percentage is large. Sister Amal, I think our approach is slightly different. We are not talking about just a percentage. The mechanism that AAOIFI provides is that you should not be defining a percentage of deduction of PR or IRR, which is defined by some countries. Rather, what we are saying is that you calculate. Okay, if you allow me, I'll show you the PowerPoint. This is part of the discussion towards the end, which we may not be able to handle today. But just for the sake of this clarification, I'll take you through this. So for us. Now, if you see that for the PER, what we are saying here, I believe you can see the screen. Okay. For the PER, we are saying that sample computation of PER would work like this, that you need to calculate the best estimate of maximum impact of rate of return risk, that is average change of rate of return on asset side. Then add the best estimate of maximum impact of rate of return risk, average change of average rate of return on the investment account deposit side. That additional impact of displaced commercial risk, including where applicable liquidity considerations, if any. So you add the maximum impact of risk that can be there, which can impact your rate of return. You make a total possible impact like this. Then you mention that total expected level of absorption of A by IRR related to respective classes of stakeholders subject to maximum amount of IRR actually maintained. So how much of the rate of return on the asset side will be addressed by IRR? It is possible that it is fully addressed by IRR, or it is possible that it is less than IRR, then or more than IRR. So in that situation, you keep the difference. Then we are saying expected level of absorption of A by combined amount of allowances for credit losses, impairment, NRV, etc. under FAS 30. So whatever is provided under FAS 30 will also be kept here. So D minus E and F, that is G and E is equal to total expected total impact of absorption by E and F limited to maximum amount being equivalent to A. So not more than A. So now A, B, and C is the total possible impact that can need to be covered by the risk reserve. Then A is partially handled by IRR and the provisions. So you reduce A by E and F. So A may become 0 or A may still remain there. And then you reach the adequate level of PR. Now this adequate level of PR, we have required that this PR requirement should be calculated according to this, and this should be developed over a period of time according to a policy. So you develop a policy that this PR need to be covered over a period of 5 years, 7 years, 10 years, and that will give you the percentage. So we are not saying that regulators simply define a percentage or put 1% APR. No, this is arbitrary. We believe that arbitrary is not good. What we believe is correct is that instead of doing arbitrary, you need to do a proper computation-based mechanism. Thank you very much, Sister Amal, for a very important point. Because we have limitation of time today, so I'll not be discussing this point right now further. Just a second. Okay, so we will be just addressing this comment later, maybe again when we discuss more details about this one in the next public hearing, inshallah. So we move to the next section, commingling of funds. Right now we are in the main part B, which is related to components of IA's strategy and policy framework. And we are saying that these all must be done before you commence your operations, or when you adopt the standard, you need to document all of it. An institution may commingle its equity funds and or funds of other participating stakeholders, including other classes of IA's fund based on al-Wakala will Istismar with the funds of IA's and investment pools, subject to relevant contractual arrangements and regulatory requirements and respective Sharia principles and rules. Commingling of funds of different classes of IA's with equity fund and other participating stakeholders funds shall be performed only in a manner that A, the interest of the respective IA's or class of IA's are not jeopardized, the relevant regulatory requirements and contractual arrangements are conformed to, the respective Sharia principles and rules are complied with. Insofar as practicable, the funds obtained under different contracts shall be kept under respective investment pool, and in the case of unnecessary commingling, for example, commingling of al-Wakala bil Istismar fund with Mudarba funds, or commingling of Sharia compliant preference share Sukuk funds with common IA's fund, the same shall take place only after having documented an internal investment contract that is defined terms and conditions, preferably approved by those charged with governance, ensuring maximum safeguard of the interest of the respective classes of stakeholders, warranting such arrangement taking place at an arm's length basis, and having obtained explicit permission of respective IA's and other stakeholders. Equity funds of the institution for the purpose of requirement of the standard shall include the following. So the capital can be there. You can have the current account and third-based other accounts and deposit accounts with the permission in case of permission, etc. And these are the Sharia requirements which are related to that. Similarly, Tawarruk related funds which are not preferred by AAOIFI, but if you have Tawarruk based funds, those can also be kept, and retained liability where the contract is not defined. Sister Zahra, I think this paragraph 26B4 need to be clarified a bit. What we want to say here, we just need to clarify them. Okay. Priority of investment of funds. That is the next section. So time is limited, but otherwise I would have told a joke on this part. The point is simple, that if you have the money of the investment account holders, you need to decide whether they will get a priority of investment or your own funds will get a priority of investment, or within investment account holder categories, which one will have priority of investment, which means that if there is excess liquidity, to whom that excess liquidity pertains. If there is excess liquidity in the pool, it means that average return on the pool will reduce. So this is where we have come up with this requirement for the priority of investment of funds, which need to be defined properly. Brother Nabil Najib has a comment on paragraph 21. Instead of separate pools, can we allow to maintaining one pool for both shareholders fund and all types of IAs and assets, and then the net output of the pool distributing manually based on the proportionate share of each investment type in the pool and weightages? Brother Nabil Najib, still there will be some of the investments, some of the assets should be out of the investment pool. So for example, fixed assets of the institution, anything related to general working capital of the institution, etc., they will still be in the shareholders pool only, not in the pool. Yes, it is possible to have only one general pool, which means that only there is one institution shareholder pool and one general pool. General pool will also have shareholder fund. So yes, it is possible to have one single pool if you operate in only one currency. If you operate in multiple currencies, then you cannot have more than one pool. Second issue is that the risk appetite of different investment account holders may be different, and the expected returns that you want to give to different investment account holders may be different. That may require you to bring in multiple pools. This particularly applies for high net worth individuals and for financial institutions. The third issue is that depending on the nature of the underlying assets, you might need to have multiple pools to have averaged out and appropriate returns. So that is the reason that we do not insist on having one pool, but we suggested to keep minimum number of pools. But for currency, you might need to have additional pools. Otherwise, what happens that when you reconvert, that there will be losses or there will be extraordinary gains in the other currency because of reconversion. That is a more complicated issue about currency, so I'm not going in detail, but the nutshell, you can have one general pool, and it is recommended that if you can work with only one general pool, it will be very good. One last thing, because we have suggested weightages related controls, so it will not be good that if you give weightage of 1 to a common depositor and weightage of 12 to a high net worth individual. But the limits that we have provided are maximum up to 2.53 times, which means that it's still a bit fair. But keeping something on 10 times or 12 times will make a problem. So that is the reason that we do not suggest to keep only one pool, although we have suggested to keep minimum number of pools. Thank you very much, Brother Nabil. It was a very good comment. I hope I was able to answer your comment. If such policy in any manner does not give priority or at least equitability to the investment account funds in this respect, or allows for keeping idle funds for maintaining liquidity, the same shall be in compliance with the Sharia principles and rules, explicit contractual arrangement and regulatory requirements. What I wanted to emphasize here was that Sharia principles and rules, the written permission of the investment account holder and the regulatory requirement need to be considered for the priority purposes. Next point is about determination of PSRs and weightages for distribution of profit. This is one of the most complicated sections here, and most this will impact some of the things. An institution shall at a minimum consider the following factors for determination of PSR and weightages. The PSR, including the Mudarif share and the weightage applicable to IAs and the owner's equity, shall be based on a fair and equitable approach to a distribution of profit based on average balances. Paragraph 39 addresses this issue in more detail. Net losses, if any, attributable to investment pool shall be allocated disregarding the PSR and weightages based on average balances of the investment accounts and owner equity. This is the Sharia requirement. Determination of PSR may take into consideration the following subject to other considered requirements of the standard. Any regulatory requirements and limits with regard to the determination of PSRs and expected yield of the underlying assets of the investment pool. Relevant, preferably Sharia compliant benchmark rate applicable to equivalent investment assets. In indirect expenses or operational costs incurred by the institution in managing the IAs in the respective investment pool, and any other rational and objective parameter factor resulting in a fair and equitable treatment among different stakeholders. Once determined for a PLC period, the PSRs and weightages should not be changed unilaterally. Any change for a subsequent PLC period in respect of the PSRs and weightages shall take place before the beginning of such PLC period, subject to the requirements of paragraph 83. 83 is about transparency and disclosure of these ratios in advance. Determination and allocation of different weightages where applicable to PSR to different class of Is within an investment pool shall be subject to the following consideration. An institution shall maintain a suitable range ratio between minimum and maximum ratios for investment pool in line with the relevant regulatory requirements. I think there was a comment from our brother about regulator. So in case of LRIs, the maximum weightage applied to a class of Is shall not be in excess of 2.5 times of the minimum weightage applied to any other class of Is unless a stricter requirement is imposed by the relevant RSA or is self-imposed by the institution itself as a policy matter. So now we have one comment, the comment that we received earlier, and I responded that we have kept it in the hand of the regulator, but we kept it in the hand of the regulator for a stricter requirement. So now the question would be, to that extent, your comment will be valid, that we have not allowed the regulator to make it more than 2.5. Because if the regulator allows it 10 times, then the whole purpose is failed. The objective of having this thing is to make sure that the fairness element, which is fundamental to Mudarba, is there. Now, you can have an argument that, Umar, you are saying 2.5 is fair, but I believe 2 is fair, or somebody else can stand up and say, I believe 10 times is also fair. We believe that there are two aspects. One is time and one is amount. The time and amount both need to be given consideration, but they may not be given consideration 10 times or 5 times or 7 times or 8 times. We believe that our suggestion was initially 3 times maximum, but then we made it like 2.5 times to not even make it 3, keep it less than 3. But this is where we would still like to have comments from all the regulators, practitioners, institutions from around the globe. Brother Sadaqat has mentioned a comment, why weightages are based on amount, that is higher amount, higher weightage, and lower amount is given lower weightage, so rich investor would receive more. Brother Sadaqat, let me give an example, although the time is ending, but normally the example that I give here, let's take an example, Brother Sadaqat, you are traveling in an old car, which is stopped, and the battery has failed. Now you need people to push the car to get it started. Okay. So now you sit in the car and you see that there are some children around. Some are weak and some are very healthy children. So you ask them, okay, all of you, please push the car. I'll give you like 100 BD. Now they have to push the car to make sure that the car gets started. So initially, only 2 of the children came and they started pushing, but it was not working. It was not working enough. So then more children came. Now, out of the children who came, total 7, 8 children who were pushing the car, some were very healthy and some were weak. Healthy ones were putting more effort. And then some of them came in the beginning, but they got tired early and they got out. And others came in and they continued pushing. Till the time, after maybe a few hundred meters, you were able to start the car. Now, you have to distribute that 100 BD to these 8 children. How you will distribute? What will be just and fair? For me, just and fair will include, number 1, based on time. Who continued for the maximum time? Am I right? The second consideration for me will be the power, how much power each one of them, how much strength each one applied to that. So the healthier ones who put more power to that, their impact was more than the weaker ones. The same analogy I will apply here. So if I have an investment pool in which there are multiple assets, so first thing is time. A person who commits that I will be available for investment for 5 years, you keep my investment for 5 years. Number 1, from the regulatory perspective, you don't have any, for most of the long-term time liabilities, you don't have a capital adequacy requirement or very minimal capital adequacy requirement, which means that it gives you more opportunity of doing business without putting your capital. That is one justification. The second justification is that long-term assets give you a better long-term deposits, long-term investment accounts give you a better liquidity profile, which means that you can go for long-term assets as well. So you can go for long-term assets like 10 years, 20 years, like housing finance, etc. So it gives you better opportunity to go for long-term thing. So this is based on time. Now coming for the amount part, some people say that amount part is not justified. But sir, I would humbly suggest that even amount part is justified. So I may have 100 depositors who bring 100 BD, and I can have one depositor who brings 100,000 BD. Now the administrative cost for handling that $1 million, 1 million BD depositor, 100,000 BD depositor is less as compared to the handling cost for all of these, because this handling cost involves having multiple branches, ATMs, everything. Not only this, the bigger amounts give me a potential to invest more and go in for the bigger transactions. Smaller amounts keep me at risk on this part. So having a higher amount, number one, reduces the administrative cost, etc. And also it increases my opportunity for having bigger businesses. So from that perspective, even the amount part is justified. But we have mentioned some of the things in the standard as well. The weightages as far as practical shall be denominated in easily understood numbers. For example, 1 to 2 is to 5 and 100 is to 100% to 250% to make them understandable. Because people put it 0.375234 versus 1.362598. I have seen these things, honestly, which doesn't give you actual things. So we are saying that they should always be given in more understandable number starting from 1 or 100% to them. The differences in weightage within the same investment pool shall be justified only in and to the extent as justified under either of the following situation. A higher weightage of class of either a longer investment period or the element of profit payments at maturity at longer intervals commensurate with the benefit to the institution and the greater interest of all stakeholders by way of managing the liquidity, decrease operational cost, ability of the institution to take risks on long-term underlying assets, etc. Or a reasonably but not significantly higher weightage. Here we are saying it cannot be a significantly higher but reasonably higher weightage to classify IAs with higher average amount of investment as compared to other IAs, commensurate with the benefit of the institution in the greater interest of all stakeholders by the way of reduced operational cost, or a reasonably but not significantly higher weightage to a class of IAs due to social and environmental but not commercial consideration. This may include IAs held by the widows, orphans, senior citizens, WAF, charitable organizations in line with overall sustainable finance strategy of the institution. Determination of PSRs, an institution shall apply the following consideration to the Mudarib share applicable to each investment pool. Mudarib share shall not be variable, it must be fixed and disclosed before the commencement of a PLC period. Sister Zahra, normally we don't put semicolons. We just note it in the sentence. We need to correct this part. Just make a note of it. Any voluntary reduction in Mudarib share during or after the completion of a PLC period applied as a profit smoothing technique shall be subject to similar consideration as specified in general and specific YOBA in line with the requirements of this standard. There must be a cap on maximum Mudarib share in line with the relevant regulatory requirements. In the absence of relevant regulatory requirements, the institution, considering the market factor, shall put and adequately disclose an internal cap on maximum Mudarib share, which shall not exceed 50% of the distributable profit of the respective PLC period. So here we are defining the first right to the regulator, and then we are saying that if the regulator is silent, then you give 50% maximum, 50% maximum. In case of different Mudarib share being applied to different classes of IAs within the same investment pool, in addition to the requirements of paragraph 31A to 31C, it shall be ensured that the requirements of fair and equitable weightages as contained in paragraph 29 to 30 are not avoided by using a different Mudarib share mechanism. This is a caveat because some banks have a Mudarib share, different Mudarib share within the same investment pool, which works like a weightage. So that's why we have said that it should not, if you are using this formula, it should also not be used to circumvent the requirement of the other requirements. Commingled equity related funds, including other funds attributable to equity, for example, funds on per basis, etc., may not be assigned any weightage, and accordingly proportionate profit shall be first allocated to all such funds based on average balances before application of Mudarib share and weightage of different classes of IAs within the investment pool. This is again one of very important consideration, because you are commingling two type of funds, so you cannot assign the commingled fund a different weightage. Rather, the distributed profit will be going separately because they are not in the same contract. They are in different contracts. So the commingled funds will be separated first without assigning weightage, and then weightage will be assigned to the same investment account holders having the same contract within the same pool, and it will not be applied that mudarib weightage to be applied on the wakala funds or on the equity funds. This is again one of the very important considerations that we have put in this standard to ensure Sharia compliance and equitable treatment. In case of high-risk investment accounts, we have said that different HRIs should not be subject to different PSRs or weightages based on the amount of investment, and the risk of loss is higher, and hence it is only fair and equitable to keep the profit shares commensurate with the risk of losses. Risk of loss is everybody's equal. So that's why we are saying that in high-risk investment account, weightages, etc., generally should not be there. Even if different weightage may be justified due to other elements in line with the requirement of 30C, the maximum weightage applied shall not be in excess of 1.33 times of the minimum weightage applied. This is because the risk factor is equal and it is high risk. Risk factor is equal. So the gain factor should also be equal, or at max it should be not more than 33% higher. The Madarib share in all cases shall not be in excess of 33% because it is a high risk investment account. So we should not be having a Madarib share more than 33%. And 20% for all RIAs unless different limits are specified by relevant RSAs. Now, I think our time is over. It's a very long standard. I personally love this discussion, but I'm afraid we have to stop here, and we'll have to try to cover the remaining sections of this standard in the next public hearing, in which we will not be covering up to paragraph 33 in detail. Rather, we will be just taking any comments that come from the participants. Otherwise, we'll take it forward from this point onwards. Here, I will just stop and take a little bit questions that are already there. 5 questions are already there. We'll take it there, and then we'll try to close the session today. First comment is from Brother Sadaqat. Why weightages are based on amount that, okay, this one is responded already, Sadaqat sir. Mom, Brother Ayub has a comment for paragraph 30, determining and allocating different wages in standard may better provide a proper system. The sum of weightage to all categories must be equal to 1, 10, or 100, depending on the scale applicable. It will reduce the maneuvering power of the bank. Increasing weightage for one category would mean decreasing weight for other categories. As a result, any special weight shall not be allowed to any particular customer to shift more profit to that customer. Ayub sir, we'll take your comment. The way we have defined is or more or less the same. We said that you have to put the weight as 1 and maximum as 2.5, or 100 and maximum as 250%, 100% versus 250%. So practically we are saying the same thing as you are saying, and it is more understandable the way we are putting. But again, we fully there is no disagreement on the conceptual part. How we can do it, we can consider to add your option also. There is comment from Brother Sam Kadwai. So just to clarify this point, if a deposit is for 1 month having 20% weightage, the other deposit for 12 months cannot have a weightage more than 50%, that is 2.5 times. Yes, that is correct. Thank you very much. This is correct. Brother Nabil Najib has a comment again, considering the time is justifiable, but the amount. So his comment is that amount is not justified. Brother Nabil Najib, as I mentioned, that amount, we said it can be reasonably, but not significantly higher. Reasonably, but not significantly. Why reasonably? What is the reason behind that? To what extent you can do it? Our answer is that it should commensurate with the actual benefit on the liquidity raise, with the actual benefit on the reduced operational cost part. So from that perspective, again, we need to be fair with the rich also, to be honest. We shouldn't be against all the rich people. So for me, having the higher amount of deposit also give benefit to the pool. So a reasonable compensation for that added benefit should be there. So it's not that Islam is against the rich, or Islamic finance is against the rich. No, it is about fairness and equity. So we are saying that higher amount of deposit, the example that I was giving was like in the children case, that the children with the higher, if those two healthy fat guys were not there putting a maximum effort, your car would never start. all the weak guys may not even be able to start the car, because you need to achieve that specific strength at one point of time, specific speed to get to start the car. So always having the higher amount will also be justified. Justice and fairness is what is needed. We are not here just to support. Yes, we are all in favor of the majority, which is the poor guys. But at the same time, if the rich guy is coming to Islamic finance, we don't want him to just run away because we are not compensating him on a fair basis. That fairness includes this element. Brother Sadaqat has said, good justification, that looks logical. Thanks on behalf of AAOIFI as well. Our pleasure, sir. And your wording is always very much, appreciating for us. Thanks a lot. We have another comment from Brother Sadaqat. Before that, let me quickly just go to there is comment from the Omar Khalif. My apologies. I always have to apologize. People join us from so many different countries, so many different regions. At time we mispronounce the names. So if I mispronounced any name, my apology for that. Can you expand on how to better manage the regulation of the investment pool? Actually, the section actually addresses this whole standard is about addressing these parts. Some of the sections related to profit loss computation, etc., are coming later in this standard. In this regard, may Allah give you Ajri Azim. Thank you very much, Ameen. I strongly believe this standard is very crucial for IFIs, and if adopted, applied by IFIs management appropriately, it would certainly improve the overall level of Sharia compliance, risk management process, and enhance the confidence of invested account holders and other stakeholders of IFIs, consequently safeguarding the reputation of the Islamic finance industry. Thank you very much, Sadaqat Sahab. Your comments always mean a lot for us. So with that, I think we have to complete the session now, conclude the session now. Sister Zahra, do we have a decided date for the upcoming public hearing?
Not yet, brother, but we will try to have a gap. Weeks before.
Yeah, gap is needed, and then try to register all participants for today and invite all of them today for the main, because today we couldn't complete it. And one last request again, that whoever has comments in writing related to the section discussed or sections not yet discussed, please feel free to send to us. And anybody who want to have to be part of the survey, please provide your comments in the chat box. A lot of participants actually provided, but if anybody else also want to provide, please feel free for that. With that, I would like to thank you all for patient listening, and my apologies for not being able to complete the standard. I think we need to plan for these long standards, longer public hearings. But again, having longer public hearings, it doesn't suit everybody. So maybe we need to have them in installments or something like this, like we are planning now. So with that, thank you very much again. Assalamu alaikum.
Thank you so much for the participants, for you, Brother Umar, and of course for our partner, State Bank of Pakistan. Please feel free to send us your comment on governance at AAOIFI.com, and check our website and social media platform for details about our upcoming events. Once again, thank you so much. Fi aman Allah.